Hello everyone, how are you all? I hope everyone is absolutely fine. So exams are finally coming, and in this particular session, I have completely covered the amalgamation of companies chapter, CA Intermediate Advanced Accounts, amalgamation of companies, and that too in English language. This particular session is especially recorded for southern part of the India. That is for those students who couldn't understand Hindi. So this entire session is approximately of 4 hours, and entire 4-hour session is dedicated to the amalgamation of companies chapter. As far as concepts are concerned, everything is covered. As far as question discussion is concerned, maximum question part is also covered, so that you will be able to understand the entire amalgamation part, whether it is a point of calculation of purchase consideration, books of transferor company, books of transferee company, amalgamation in the nature of purchase, in the nature of merger, and other adjustments also I have covered in this session. This is just a one session, and in one session only you will be able to complete your amalgamation part so easily. So how you will take the benefit of this session? First of all, what you need to do, that I have used some of my notes. These are the notes. This is a master problem PDF. I'm sharing this PDF with everyone as an LDR, last day revisions. So if you are short of your revision time, you can do these questions only in every particular chapter. As far as amalgamation is concerned, amalgamation master problems are also given. You can do these questions only as for the exam revision. There are total 151 questions. So as far as amalgamation is concerned, I have used this file. You can also use this file as an amalgamation. All the conceptual part is there, and the question part also is there. Now, how you will get these PDF? You will get this PDF by visiting to my Telegram channel. The link of the Telegram channel is given in the description. You will click the link and you can join the Telegram channel. After joining the Telegram channel, you can get the Google Drive link of a particular this folder. This is a CA Intermediate all-in-one folder for exams. In this link, you will get everything, all the master problems, all this amalgamation PDF notes, even whatever class notes I used for this amalgamation chapter, whatever I have discussed, everything is written. These handwritten notes I have already uploaded in this link. The link you will get in my Telegram channel. The Telegram channel link is definitely available on the description side. Okay. Now, if you can watch the entire session of 4 hours, I can challenge that after this session, after watching this session, you will be definitely confident for giving the exams and for the amalgamation problem. So all the very best. I hope you will like this lecture. And if you will like the lecture, just share this lecture with your friends also, and give me your feedback also as far as this session is concerned. I'll wait for your feedback also. Thank you so much, guys. And now the main part of the session will continue. Thank you so much. Thanks a lot. Now we are starting the session, and we are starting the session for amalgamation. So we have decided to give particular session for amalgamation because amalgamation is a very important topic. We all know, and we can expect approximately 10 to 14 marks from this particular topic. Okay, but suppose if you are not familiar with the notes, not an issue, don't worry. You just need to listen to me. You should have your copy and pen and calculator with you. Whatever I will teach you, you need to write it if required, if it is possible. If it is possible, if such thing is not given in the notes, you just need to write. What we are going to do, we are going to discuss the entire amalgamation along with the question practice. I'll try my best to give you some good questions practice also. So let's start. Guys, amalgamation of companies. Amalgamation of companies. It is governed by AS 14. Now, in this amalgamation, let's start. First of all, let's start with the basics. There are two parties. In the amalgamation, there are two parties. One, the transferor, and second, the transferee. Okay. Transferor, I'll call it RER. Transferee, I will call it RE. Okay, in short. So now, who is transferor? Who is transferor? So transferor, whose business is getting sold. Whose business is getting sold. So the transferor whose business is getting sold. And transferee, that means a buyer. Buyer, who is purchasing the business. Who is purchasing. purchasing the business. All right, next. Sir, what is business? Now you would ask me, sir, what is business? Basically, so business, here we call business means all assets and all liabilities. All assets and all liabilities, or all assets minus all liabilities. That means business means net assets. So logically, transferee purchases the net assets of transferor company. Transferee purchases the net assets of transferor company. I'm sure you must have got this point. Next. Now, in this chapter, we are understanding the accounting treatment or the books of accounts of transferor as well as transferee. We'll discuss both the accounting treatment for both of the companies. Okay. So as far as transferor company is concerned, whose business is getting sold, this company will get liquidated. This company will get liquidated. Okay. This company will get liquidated. All right. Now, transfer company will get liquidated, and transfer is a purchaser company which will apply AS 14. Now let's first talk about books of transferee company. Transferee means purchaser. Transferee company means purchaser. Okay, let's talk about the transferee company. Here we'll apply AS 14 for the accounting treatment. Okay. Now the most important thing under amalgamation is purchase consideration. Sir, what is purchase consideration? Sir, what is PC? What is purchase consideration? Basically, when you buy something, whether you will buy at free of cost? No, of course no. So when we buy something, we need to pay something. Na? If we are buying calculator, we need to pay money. In the same way, if we are buying the net assets of the company, the net assets of transferor company, of course, obviously, we have to pay something in return. Are you guys understanding or not? Yes or no? So PC is what? PC is a consideration in return of purchase of net assets. PC is a consideration for purchase of net assets. So what is PC? PC is consideration for purchase of net assets. All right. So when we talk about PC, it is to be paid by or discharged by. PC is discharged by whom? PC is discharged by, wait a minute. PC is discharged by transferee company in the form of cash, equity shares, preference shares, or debentures, etc. So PC can be paid in any form. If I'm paying cash, it's a PC. If I'm paying equity shares, it's a PC. If I'm issuing preference shares, debentures, it's a PC. But the most important thing is PC discharged by transferee in the form of cash, equity shares, preference shares, debentures. To whom? To shareholders of transferor company. So PC is paid by transferee to the shareholders of transferor company. When I say shareholders, I mean preference shareholders and equity shareholders. Guys, till now, have you understood this concept or not? Please tell me in the chat. Have you understood this concept or not? All right. You can ask me any kind of doubt. Don't worry. Okay. You can ask me any kind of doubt. If you have, you can just type your doubt. I'll read. All right, guys. So PC is paid by transferee company in cash, in equity shares, in preference shares, in debentures, in any form. To whom? To the shareholders of transferor company. Now, I'm asking one question. Please answer me. I'm paying cash. I'm issuing equity shares to the creditors of transferor company, to the debenture holders of transferor company. Is this a PC? Is this a PC? Very good. Very good. Everyone is saying no. Very good. It is not a PC because I'm paying cash, I'm paying equity shares, not to the shareholders, to the other parties. To the other parties like creditors, debenture holders. It is not a PC. So what's that, sir? It's a settlement of liability. So whenever I pay cash, whenever I issue equity shares, preference shares to the creditors of transferor company, to the debenture holders of transferor company, to any other party. It's a settlement of liability. It's not a PC. For example, I'll tell you one thing. Suppose you are running a business and you are a transferor company. You guys are running a business and you are a transferor company. I am a transferee company. I acquired your business. In your business, earlier you had taken a loan, a bank loan. You had taken a bank loan from SBI. Now what I did, I acquired your business. I acquired all the assets of your business. I acquired the loan also of your business. Like the loan which was in your name, now it is in my name. I acquired assets as well as I acquired that loan. Now the loan is transferred in my name. I am a transferee company. So as soon as it is transferred in my name, now loan is mine. It's a my liability. So now I have full authority to settle this loan in any way. So what I did, first I purchased the asset. I purchased that loan also from you. And then I settled it. It's a very simple thing. So whenever transferee company pays or discharge to the creditors of transferor, to the debenture holders of transferor, it means that I purchased it first and then I settled them. All right. I hope you got this point. So any payment to creditors, debenture holders, other parties by re is not PC. It is a settlement of liability. It's a settlement of liability. I hope you got this point. Okay. So in the amalgamation, transferee company has to discharge PC to the shareholders of transferor company. Sometimes transferee company also settle the liabilities also, but that is not a PC. Okay. Now, if we talk about PC, purchase consideration. If we talk about PC, purchase consideration. Okay. Now, this is going to be very, very important point, very, very important topic. So please listen to me very carefully. PC, when we talk about PC, first golden rule of PC is always depending on market values. PC is always based on market values. Market values. This is the primary golden rule of PC. If in question the market values are given, you have to consider such market values for the purpose of PC. Okay. You have to consider such market values. But suppose if market values are not given, then you can consider the book values and assume that such book values are the market values only. So first golden rule of PC. First golden rule of PC. PC is always based on market value. Now some of you may ask me, sir, why market value only? It's a very quite simple thing. If you are purchasing the calculator, obviously how much will you pay? Obviously you will pay that much amount which should reflect the fair value of the calculator, of course. So fair value means market value. Let's talk about land. Let's talk about land. Suppose land which was purchased by my grandparents, a land which was purchased by my grandparents 50 years ago. So sir, in 50 years ago, the land was purchased at just 1,000 rupees. Just 1,000 rupees. Now such land is in my books of accounts. What was the cost of the land? The cost of the land was just 1,000 rupees. So in my balance sheet, the land is appearing at 1,000, a book value. I'm not revaluing it. It's my wish. Okay. Now I'm going to sell this land to you. Okay. I'm going to sell this land to you. Of course, I would sell it at market value, no? And of course, I will demand the market value from you. You cannot say that, sir, it's a 1,000 rupees of land in your balance sheet. I have seen your balance sheet, sir. It's a 1,000 rupees of land. Just sell it to me at 1,000 only because you are showing it at 1,000. I would say What you are trying to say? Because the land which was purchased 50 years ago at 1000, I'll not sell it at 1000. I'll not sell it at book value. Of course, I will demand the market value, na? And you have to pay me the amount as per the market value. So simple thing. Whenever you purchase the business, of course, the RER will demand the market values. So PC is always based on market value. I hope you are clear with this point. Sir, why you are focusing so much on market value? Because some of the students get confused with the market value and the book value while calculating PC. And this is the reason I'm saying, please consider market values only if you have that market values. Guys, understood or not? Please tell me. Everyone, please tell me, have you understood the concept or not? All right. Thank you so much. So the first golden rule is PC is based on market value. Now, how to calculate PC? Now, how to calculate PC? Now, how to calculate PC? How to calculate PC? I will give you 3 important basics about PC. And believe me, the PC will be calculated on these bases only. Don't worry. You just need to learn these concepts and that's it. The first basis of PC is the first basis. The first method. Method 1 is exchange ratio method. Method 1 is exchange ratio method. The first basis is exchange ratio method. Exchange ratio method. So what is exchange ratio? Sometimes the question will give you ratios like 3:2, 5:4. You must remember this. Huh? Okay. So what is that? 3:2. What is the meaning of 3:2? For every 2 shares, of RER company, I will issue them the 3 shares. Okay. For every 2 shares, I will give them 3 shares. So what is the meaning of this? For every 4 shares, I will give them 5 shares. You have to do like this. Tell me in the chat or in the audio, what is the meaning of this? Tell me, what is the meaning of this? (17:13). What will you say? Very good. For every 13, we'll give you 17 shares. For every 13, we'll give you 17 shares. So this is an exchange ratio method. This is an exchange ratio method. So how would you calculate the PC in this? How would you calculate the PC in this? So if you can look into my notes also, I have given some of the examples. Please come to this point. I have given some of the example number 3, the concept note of amalgamation. Okay, you will find these concept notes of amalgamation. So if you come to this example, A Limited transferee acquired business of B, transferor. B Limited has outstanding equity shares of 2 lakh numbers. So transferor has 2 lakh numbers. A offered 3 shares of its own company in exchange for every 2. So for every 2, I will give you 3. So what is PC? So for 2 lakh number of shares, PC is anything which is paid to the shareholders. So shareholders are holding 2 lakh shares. I told you already that PC is anything which is paid to the shareholders. Now, so shareholders are holding 2 lakh shares. So for every 2 shares, I will give them 3 shares. So how much I will give them? I will give them 3 lakh number of shares. I will give them 3 lakh number of shares. And my share price is, my market value share price is 25 rupees. 25 rupees. My market value to a share price is 25 rupees. So multiply by 25. So the PC becomes 3 lakh multiplied by 25. It becomes 75 lakhs. It becomes 75 lakhs. So what is the format? The format is payment to equity shareholders of B Limited. Payment in equity shares of A Limited. This is the working. 2 lakh number of shares into 2, divide by 2 into 3, multiply by 25. And this is the amount of PC. I hope you got this point. Tell me, understood or not? Understood or not? Okay. The same question, once again, please see the question. Now, B Limited is a transferor company. It has equity shares of 150 numbers, preference shares of 80,000 numbers. So both are the equity shares and preference shares. Both are the shareholders. We'll give them the PC. So A Limited is taking over the business of B Limited. So B Limited is a transferor company. Exchange ratio is 5:4. What is 5:4? What do you mean by 5:4? 5:4 means for every 4, I will give you 5. As far as equity is concerned. And as far as preference is concerned, what is the ratio? The ratio is 3:4. For every 4, I will give you 3. And what is my market price? I will give you share based on my market price, market value. I already told you that PC is always based on market value. PC is always based on market value. So what is the market price? The market price of my equity share is 60 and market price of my equity share is 20. So what is PC? So payment to whom? Equity shareholders. Payment in the form of equity shares. And what is the working? Equity shareholders numbers are 150. So 150 multiply by 5:4. Multiply by 5:4 into 5 divided by 4, multiply by 60 rupees equity share. This is the PC, and same way we calculate the PC for preference shares also. Sir, suppose in your question the market values are not given. Suppose in your question the market values are not given. What will you do, sir? The face value, because I don't have any other option. I don't have any other option now. I will issue the shares at face value because I don't have any other choice. So whenever the market value per share is not given, use the face value. Guys, are you understanding? Are you understanding? So this was the first method of PC. I hope you got this point cleared. So method 1 is exchange ratio method. It's a quite simple method. Now, let's once again understand the concept. Suppose you have 3 lakh number of shares. Transferor has 3 lakh number of shares. The exchange ratio is 4 shares for every 7. Now, whenever I will do 3 lakh 4 shares for every 7, there will be the fraction. 3 lakh divided by 7 into 4. There will be the fraction 171,428.571. So 0.571 is the fractional amount. It's a fractional amount. 0.571. So I cannot issue the shares in fraction. I will issue the shares 171,428 only. I will issue 171,428 number of shares only. For 0.571, I will give cash. So payment to whom? Equity shareholders. Payment in the form of cash for 0.571 multiply by share value of one share. For one share value. So this is 30 rupees. My one share is 30 rupees. I will give you the cash. Of course, you must have understood this concept. Okay. So this is the one basis of PC, exchange ratio method. Now let's come to the another basis. Yes. Any doubt in respect of this exchange ratio method? Any doubt in respect of exchange ratio method? Wait a minute. No doubt? All right. Only few participants are actually replying to me. So why so? Only few participants are replying. Simran, last point, cash concept. Please tell me. Cash concept. So it was a simple. Dear, when you will do this exercise, 3 lakh divided by 7 into 4, you will get this amount 171,428.571. So share cannot be issued in fraction. Fraction means point. In shares, we cannot issue the shares in points. So for the point is concerned, see, if I write 1, so it is a 1 share. If it is 0.571, so it's a 0.571 share. It is less than 1. So this share cannot be issued. So what I will do, for this value, I will give you the cash equal to 30 rupees. Because for this value, I will give you 30 rupees share. So for this value also, I will give you 30 rupees cash because my market price is 30 rupees. My market price is 30 rupees. Simple. Okay. Method 2. The method 2 is deemed exchange ratio. deemed exchange ratio. The first one was exchange ratio. The method 2 is deemed exchange ratio. Sir, what is deemed exchange ratio? It is used when proper exchange ratio is not given, but market price per share or intrinsic value per share is given for both companies. I'll give you the examples, don't worry. Deemed exchange ratio. We'll apply this deemed exchange ratio when proper exchange ratio is not given. Like this. The exchange ratio is not given. So what we will do? When the proper exchange ratio is not given, we'll apply the deemed exchange ratio. When to apply deemed exchange ratio? When we have market price per share or intrinsic value. Sir, what is intrinsic value? For the time being, please consider intrinsic value as a market value. I'll give you the detail about intrinsic value, don't worry. But for the time being, just assume the intrinsic value, market value, fair value, all are same. Okay, so market price per share or intrinsic value per share is given for both the companies. Whenever these prices are given for both the companies, we'll use deemed exchange ratio. How? Okay, how we'll use it? How we'll use it? Let's now consider. Okay, I'll give the example here only. See the example. See the example. Transferor has 1,50,000 number of equity shares. Transferor has 1,50,000 number of equity shares. Market price per share transferor is 30 rupees and market price per share transferee is 45 rupees. Now if you can see, they are asking you calculate PC. Now whether the exchange ratios, proper exchange ratios are given? No, the proper exchange ratios are not given, but we can find out the PC with the help of these market prices. Now both the companies market price are given, not an issue. We'll calculate the PC based on that. How? See, PC is anything which is given to the shareholders of transferor company. So shareholders of transfer company are holding 150 shares. So 150 number of shares. Now, first of all, what will you say? 150 number of shares belongs to transferor company. And every share of transferor company has a worth of 30 rupees. So if one share has a worth of 30, that means 1,50,000 number of shares must have a worth of, do it, 150 multiplied by 30, must have a worth of 45 lakh rupees. 45 lakh rupees. What I did, if the market price of one share of transfer company is 30, what should be the market price of total shares of a company? I told you guys, PC is always based on market value. Simple. If I'm purchasing your company, I will look into the market value of your company. So logically, your company has a net worth value of 45 lakh. I will give you 45 lakh rupees. It's a PC. It's a damn PC, guys. It's a PC. Now, how I will discharge this 45 lakh? I may discharge this 45 lakh in cash, but my market price is also given. And if nothing is mentioned, I will give you my shares. So 45 lakh is a PC because it's a market value of your company. Now I will discharge this 45 lakh in the form of my share and I will give you my share of 45 rupees. So divided by, I will issue my shares worth of 45 rupees. So I will issue, transferee will issue 1 lakh number of shares at 45. So it's a PC. What I did, it's a deemed exchange ratio. For your 30 rupees share, I will give you 45 shares. Earlier what we were saying, for every 2 For every 2, I will give you 3. For every 4, I will give you 5. But now I'm saying for your 30 rupees share, I will give my 45 rupees share. You have total shares of 150. I'll not give you 150 shares. I will give you 1 lakh shares only, because my share is having more worth, more market value than yours. So to compensate, I will give you only 1 lakh shares. Guys, have you got this point or not? It's a deemed exchange ratio. Now you can, now to the market value, you can call it intrinsic value, you can call it intrinsic value, you can call it issue value, issue price of the share, you can call it a fair value, whatever, doesn't matter. Please go into the names or wordings. Don't go into the wordings. These all are same, quite same. Of course, I'll discuss more about intrinsic value because it's a very important concept, but don't worry, we'll discuss it later on. It's a deemed exchange ratio. All right, guys. Another example. Transferor has 150 number of shares. Market price transferor is 30 rupees. Same. But now market price per share of transferee is not 30, is not 45. In the earlier case, it was 45. Now, I'm saying that it's 42 rupees. Let us say it's 42 rupees. Again, the fraction will come. The fraction will come. What I will do? Payment to equity shareholders of transferor. Payment in equity shares. Working. What working I will do? See, as far as transferor company is concerned, its 1 share is having a worth of 30 rupees. If the 1 share is having a worth of 30 rupees, then total shares are 150, 1,50,000 numbers. So what will be the total worth? The total worth would be 45 lakhs. So logically 45 lakh is the PC. Now for this 45 lakh, how will I issue? I will give you my share of 42 rupees. So tell me how many number of shares? I will give you 107, 142, and there is something in fraction. After this it is 0.857. 0.857. So do not write this here. Do not write this here, because I cannot issue the shares in points. So 107, 142, I will give you number of shares of rupees 42. I will give you these numbers at 42 only. So 107, 142 into 42. The PC amount becomes here 44,99,964. The value is 44,99,964. Again, PC, payment to equity shareholders of transferor. Payment in. Now here, I will give the payment in cash also because of the fraction. What was the fraction? 0.857. 0.857 multiplied by 42. Same. If 1 share, I'm going to issue the share of 42. For 1 share, I will give you 42 rupees of worth of share. For this also, I will give the 42 rupees worth of cash. 0.857 into 42. So it comes to approximately 36 rupees. Approximately 36 rupees. So the total comes to 45 lakhs only. 45 lakhs only. Guys, have you understood this concept? Have you understood this concept? So we discussed out of 3, we discussed the two methods of PC: exchange ratio method and deemed exchange ratio method. Whenever the question will come, the full-fledged question will come. Whenever the full-fledged question will come, you need to check whether they have given us the exchange ratios or not. If not, whether they have given us the market prices or intrinsic values of both the companies or not. You have to check this. You have to check this, okay? Like, Just wait. You must know that Institute has recently issued the RTPs, MTP1 series, MTP second series. Okay. Just look into those particular MTPs or RTPs if we can find out something in relation to the PC. Wait. Sorry. Okay, they have given the third method which I haven't discussed yet. Don't worry. In RTP, I have to check. Okay, they haven't given the in RTP also they haven't given the full-fledged question. Don't worry. Now, as far as exchange ratio methods and deemed exchange ratio methods, these are done. These are done. Any doubt regarding this point, guys? Any doubt regarding these points? No, na? Okay. Now, the third method. Method 3. Method 3. Method 3 is net assets method. Method 3 is net assets method. Net asset method. Next page. I will cover it in the next page. Net asset method. So here net assets method. Method number 3 of PC. Now this method 3 is also quite similar to this method 2. I will tell you. Method 3 is also quite similar to method 2 only. But first of all, let us understand method 2 properly. Method 2, net asset method. For understanding net asset method, we'll further divide this method into two parts. All assets, market values, minus all liabilities, market values, minus PC to preference shareholders. It is a PC for equity shareholders. It's one method. Second, assets acquired, market value, minus liabilities acquired, market value. It's a PC. Now, net asset method has two different concepts. Here I consider all assets, all liabilities. Here I consider assets acquired, liabilities acquired. I will give you the reasons. Don't worry. So method 3 is a net asset method. Method 3 is a net asset method. Simple. If you have deal with this chapter amalgamation earlier also, if you remember some of the questions, sometimes question says that transferee company has acquired the selected assets and selected liabilities, and sometimes question says that we acquired all assets and all liabilities. So the PC is depending upon whether we have acquired the selected assets and liabilities or we have acquired the entire business. It's quite simple thing. Suppose I went to a I went to a shopping center, let us say D-Mart. I went to a D-Mart shopping center to purchase the goods. Now, when I entered into D-Mart, I took a basket, empty basket, and I chosen the products. Whatever products I want, I pick them and put it in my basket. The product I want, put it in the basket, And at the billing counter, I paid the money for only those goods which I acquired. Simple. I haven't acquired the entire D-Mart. I haven't acquired the entire shopping center. I acquired the selected assets and liabilities. So if I'm acquiring the selected goods, I have to pay them. I have to pay for the selected goods. Now, this is the reason why the PC is calculated by this method. If a transferee company is acquiring land and building, plant and machinery, but not acquiring the furniture, which asset we will include? The assets we will include only which we acquired. That means land and building and plant and machinery. We will not consider furniture fixture. We will not consider furniture fixture because we haven't acquired. So why I will pay you? Internet connection is unstable. Guys, everything is fine or not? Actually, I got the message that internet connection is unstable. Okay, fine. Now it's okay. Okay, so have you listened to me now? I told you that if I am acquiring the land and building, plant and machinery, but not acquiring the furniture fixture, tell me which asset I will consider. Only land and building and plant and machinery. I will not consider the furniture and fixture, because I haven't acquired it. So if the question says transferee has acquired all the assets except debtors, except cash, here you will consider all the assets except debtors and cash. So asset acquired only and liabilities acquired only. Those assets and liabilities which you have acquired, consider them only. The assets liabilities which you haven't acquired, you will not give them PC. So when will you follow this method? When will you follow this method? Tell me. When transferee company acquires selected assets and liabilities. Selected assets and liabilities. So whenever you find in the question that they are not giving you any exchange ratio method, they are not giving you any market values, apply this method. Okay, one more thing. Apply all these three methods in this order only, in this sequence only. The first priority you would always give to the exchange ratio. The first priority you would always give to the exchange ratio only. The second priority you would give to the deemed exchange ratio, that means to the market values given if any, or the intrinsic values given if any. But suppose no exchange ratio is given, no market values of the companies are given, you have to consider the net asset method only. You have to consider the net asset method only. Have you guys understood this concept? And also in the net asset method, what you have to check? Whether transferee acquires selected assets or liabilities or acquired the entire business. So this method we'll apply. When we'll apply this method? We'll apply this method when transferee has acquired entire business. Means all assets and liabilities. Means all assets and liabilities. So as far as net asset method is concerned, apply this or this depending upon the situation. Depending upon the situation. Guys, understood or not? So let's understand this first now, because this is quite simple. Whatever the assets or liabilities you acquired, assets and liabilities. D-Mart example. You went to the shopping center, you picked the goods and liabilities, put it into the basket and paid the amount for them. But you entered the D-Mart to purchase the entire D-Mart. All the goods you purchased, everything you purchased, the entire building you purchased, all the stock you purchased, all the liabilities of D-Mart now becomes your liability. Everything you purchased. So obviously you have to consider all liabilities and all assets. Okay, fine. In this all asset, it may includes goodwill also, if given. Of course, it includes the goodwill also if given. Sir, here also the goodwill will be taken if given. Of course, suppose they are saying that we are acquiring these assets and these liabilities. Apart from that, we'll give them 1 lakh rupees extra for the goodwill. So it includes goodwill. Includes goodwill also. See, as far as goodwill is concerned, whenever the goodwill value is given, just consider it. If goodwill value is not given, ignore it. Simple. Okay, guys. Okay. So let's understand this method. All assets, all liabilities. And what is the PC2 preference shareholders? Guys, please tell me. You must have understood one concept somewhere in the law subject or any other any other thing, that whenever the company gets liquidated, whenever the company gets wind up, whenever the company gets liquidated or wind up, first all the liabilities need to be discharged. After paying all the liabilities, we need to pay to the shareholders, and out of both shareholders, preference as well as equity, to whom you will pay first? Tell me. Whenever the company is getting liquidated, you have to pay to the liabilities, and after paying liabilities, to whom you will pay? You will pay to the preference holders, of course. Yes, very good. So this is the same concept. So basically, if you are trying to calculate the PC for equity shareholders of transferor company, PC for equity shareholders of transferor company, so you have to, and you are calculating a PC for both the shareholders, definitely you will do what? All assets, the value of all assets minus value of all liabilities. Now out of that, you will first pay to the preference holders, then the balancing figure will come for the equity holders. The same concept applies here also. So whenever we acquire all assets and all liabilities, entire business, and if there are preferential holders also, so to calculate the PC for equity shareholders, you have to deduct the preferential holders PC, definitely. Sir, this preferential holder PC, how we will calculate? This is given in the question. This must be given in the question, that you are paying so and so amount to the preferential holders. Don't worry. This is given in the PC, in the question. Alright, guys. Acha. One more point. This method is also known as intrinsic value method. Yes, this method is also known as intrinsic value method. This method is also known as intrinsic value method. You will call it intrinsic value method. Intrinsic value method. You will call it intrinsic value method. Whenever you do all assets minus all liabilities minus PC to preference holders, the PC for equity holders will come, and it is called intrinsic value method. Okay. So, any doubt till this point? All right. All right. See the question. Example number 6. Example number 6. Example number 6. The balance sheet of Q Limited, P Limited, who is a transferee company taking over the business of Q, P will take over all assets and liabilities except cash and bank. Except cash and bank. Subject to following measurements. Building at 25% higher than book value. Plant and machinery 70% of the book value. Debtors at same value subject to 5% provisions. And there is the unrecorded tax liability of 85,000. It is accepted by the P. Now tell me, in this entire question, whether they have given you any exchange ratios. Please comment in the chat. Whether they have given you any exchange ratio? No. Because the sequence is, first of all, you need to check exchange ratios. No, they haven't given you. Whether they have given you the market prices of both the companies, P's and Q's. P's market price, Q's market price? No, no, they haven't given. So what method you have to apply? You have to apply net asset method. And as far as net asset method is concerned, now tell me which situation it falls. Tell me which situation it falls. All asset liabilities or selected assets liabilities? Tell me. The second one. Very good. The second one. Assets acquired and liabilities acquired. Yes, correct. So in this example, if you can see this, they haven't taken the cash. So what will you do? You will consider assets acquired at market value, liabilities acquired at market value. Market value only, because as per my golden rule, PC is always based on market value. If market values are not given, then only book values. So market values. So tell me, what will you do? So PC is basically the market values. Okay. So first, building market value is 25% higher. So 30 lakh plus 25%. It should be 37 lakh 50,000. Okay. So plant and machinery 16 lakh, 70% of the book value. So it's 70% only will be the market value. That means 11 lakh 20,000. Then inventory, they are not talking about anything. They are not talking anything about inventory. So take inventory as 4 lakh only. Then debtors 650, and they are saying subject to a 5% provision. All right. We take the debtors at 650 only, and we'll calculate the provision also. Separately we'll do provision also. Okay. Next. Debtors done. Cash and bank. No, we are not taking over the cash and bank. Okay. Minus current liabilities, minus loans, because all liabilities also taken over. So current liabilities 2050 and loan 1750, and there's the unrecorded liability also, which is accepted by P. That what is unrecorded liability? Unrecorded liability means the liability which is not shown in the balance sheet of the Q, which is not shown in the balance sheet of the transferor company, but we are considering this as a liability only. So current liability, loan, and unrecorded liability. This is the PC, guys. This is a PC. 20 lakh 2,500 is the PC. Understood, guys? Tell me. Have you understood this concept or not? All right. Now, look into the next example, which is in continuation of the above example. This is PC. Fine. How I will discharge this PC? Maybe in cash or maybe in shares. If cash, then 20 lakh 2,500 will be given as cash. But if in shares, how I will discharge the PC? I means transferee. If I'm going to discharge the PC in the form of shares, definitely the question will give me the market value per share of P company. See, in the above example, purchase consideration is to be discharged in the form of equity shares of P having a market price per share 25 rupees each. 25 rupees each. So this 20 lakh 2,500 rupees could have been issued at 25 rupees per share. So tell me how many number of shares I have to give. Tell me how many number of shares I have to give. Total PC is 20 lakh 2,500. I will issue the PC in the form of shares. I have only one share of 25 rupees each market value. So how many number of shares I will give? I will do this divided by 25. So I will give 80,100 number of shares. Guys, understood or not? Tell me, guys, understood or not? Okay. Clear? Now look at Again, one example. Example number 8. Look at the example. This is the balance sheet of Transferor company. Equity, reserve, liability, non-current, current. Goodwill is also there. Goodwill is there. Market value of NCA. NCA means non-current asset. Current asset, current liability at their proper value. Means book value and book market value are same. Now look at this point. Purchase consideration shall be discharged based on intrinsic value. Intrinsic value. Guys, I told you that this method is also called as intrinsic value. Intrinsic value. You call this method as a intrinsic value method, and they are saying that PC is based on intrinsic value. Indirectly, they are saying that they have acquired all the asset and all the liability. Obviously, tell me. This method is also known as intrinsic value method. The question says that the PC is based on intrinsic value method. Intrinsic values. Now, if the question says that the PC will be calculated based on intrinsic values, indirectly they are saying that we are acquiring all assets and all liabilities. Conclusion. The conclusion is we acquired all assets and all liabilities. Don't you have understood this concept? Okay. So we are acquiring all assets liabilities because they are saying PC is calculated based on intrinsic value method. So intrinsic value method is nothing. It is just taking over all assets and all liabilities. And if there's a preference shareholder, then deduct the PC to preference shareholder. If there is preference shareholder, in this question there is no preference shareholder. There is no preference shareholder. Zero. So intrinsic value of transferor and transferee, and they are giving you the intrinsic value per share of re, but they are not giving you the intrinsic value of rer. Not an issue. Not an issue. No issue. No worry. What we will do? We will calculate all asset minus all liability. Tell me. All asset. First of all, the goodwill we will consider 6 lakhs. Then the market value of non-current asset 2850. Then the market value of current asset 15 lakh minus liability 21 lakh. It is a PC. 28 lakh 50,000. 28 lakh 50,000 is a PC. 28 lakh 50,000 is a net asset. It's a PC. PC for equity shareholders. Now I will discuss this in two ways. Either this is a PC. 28 lakh 50,000 is a PC. So what I will do? See example 8. Book. 28 lakh 50,000 is a PC. Now, how I will discharge this PC? In the form of share, and my share is having a value of 30 rupees. So divide by 30. I will give 95,000 number of shares. I will issue 95,000 shares of Transferee company at 30 rupees. You consider this way. This is the first way. Or 28 lakh 50,000 was the net asset value of the RER company. 28 lakh 50,000 was the net asset value, total company's worth of the company. This is the company's worth, transferor net asset value. How many number of shares transferor has? 12 lakh divided by 10. 12 lakh divided by 10. That means 120. So if the total net worth of the company is 2850, divide by 120 number of shares of transferor. Tell me what is the net worth of one share of transferor company? Tell me what is the net worth of one share of transfer company? Market price per share, or you can call it intrinsic value per share of transfer company. What is the value? It becomes 23.75. It becomes 23.75. And you already have intrinsic value per share of re company. You already have intrinsic value per share of re company, which is 30. Guys, it becomes a second method. both the share values are given. Both the share values are given. It becomes your second method, the deemed exchange ratio method. It becomes your second method. Now market price, intrinsic value per share are given. Then it becomes your deemed exchange ratio method. You remember deemed exchange ratio method? Now, since both the prices are given, you calculated this and it was given. Please acknowledge this concept. Please tell me, are you getting this concept or not? Both the market values are given. Now, how will you calculate the PC? PC, you will pay the PC to the shareholders of Transferor company. Shareholders of Transferor company are holding 120 shares. So today, the shareholders of Transferor company are holding. Shareholders of Transferor company are 120 holding 120 shares, and they are having the net worth of 23.75. And I will give them the value of share of 30 rupees. Again, this will come 95,000 only. This will come 95,000 only. The same answer. Only two ways, two different approaches. The answer is same. Sir, what you actually want to say? I just want to say that this method, this one only, not this one. Because this method is a selected asset liability method. This method and logically this method are same. Deemed exchange ratio method, they are directly giving you the market prices. But under this method, you are calculating the market prices. You are finding out the market prices first and applying the same concept of second method. Tell me guys, now you are clear or not? Alright guys, so everything is clear. So if you guys have any doubt, you can ask me. Tell me, if you guys have any doubt, you can ask me. Okay. So these was the PC. One last thing I would discuss only as far as PC is concerned. I will give you example. One last thing. Transferor has 90,000 number of shares. Intrinsic value per share, transferor. Intrinsic value per share. Yes, Anju, we can use either of these two methods to find the discharge of PC. Yes, but final concluding point I will give you after 5 minutes. Final conclusion I will give you after 5 minutes. Don't worry. So, transferor has 90,000 shares. Intrinsic value per share of transferor, let us say 50 rupees. Please, now, intrinsic value, market value, fair value doesn't matter. Okay. Next, intrinsic value, market value per share of re also is given. ₹60. So definitely you will apply second method, deemed exchange ratio method. Both the market values are given. Simple. But one extra point is given. PC is based on intrinsic value per share, but to be issued by re at face value of 10. Only this line is extra. Only this line is extra. PC is based on intrinsic value, but shares to be issued, shares to be issued by transferee company at face value. How will you find out the PC? See, PC is what? Payment to the shareholders of transferor company. The shareholders are holding 90,000 shares. PC is based on intrinsic value. So what is the current value of these shares? The current value of these shares is 50 rupees. So this is the worth of the company. Okay. And based on this worth, I will give my share to you. I will give my share to you. My company's share worth is 60. So PC is based on intrinsic value. See, intrinsic value of RR, intrinsic value of RE. Simple. So how many shares? Tell me. 90, 50, 60. How many shares? 75,000 numbers. I will give you 75,000 numbers, but I will issue these numbers at face value. Multiply by 10 rupees. If this point is not given in the question, if this point was not given in the question, what I have to do? Obviously, I will give you these shares at my market value per share. But since this line is given, the shares I calculated based on the market values, but I will issue the share at face value. It's my wish. 750. Here I said my wish. That means it's the wish of Transferor company. See, we are giving you 75,000 numbers based on market value. Okay, 75,000 numbers. See this. We have giving you 75. Now it's our choice at what value we are recording. It's not your concern. Simple. I am giving this calculator to you. Okay. Now it's my wish what journal entry I will pass. It's my concern. It's not your concern. Simple. In the same way, whenever the transferee company issue the shares will definitely be issued based on the market value. But at what value I will record them, either face value or what, it's my wish. Okay. See, logically, Ankit, for your doubt, here we applied the method 2. Second method we applied based on market values, based on intrinsic values. Second method we applied and we got the number of shares, but only for the purpose of entry we are multiplying by 10 because it says that issued at 10. So only for the purpose of recording the entry we will multiply by 10. Otherwise we applied the method 2 only. So to calculate the number of shares, obviously we applied the method 2, but multiplied by face value. So this is a point. This is a thing where sometimes they use these kind of adjustments. Okay. So overall, now my final conclusion. As far as PC is given, my final conclusion, because after that we'll discuss few more points other than PC. Now everything is completed for PC. My final conclusion. First of all, what you need to do, because now first of all, listen to me very carefully, and if possible, whatever I'm giving you the summary, if you can write it, it would be better. So, final conclusion. Whenever the question will come, calculate the PC by applying method 1 if possible. So whenever you will calculate the PC, always go with the sequence. The first preference you will always give to the exchange ratio method. Now this method will be applied only when the exchange ratios are given. Okay. Now question giving you exchange ratios. Fine. Apply it. Question is not giving you exchange ratios. Now apply the second method. Try to look into whether the market prices of both the companies are given, intrinsic values of both the companies are given, fair values of both the companies are given, issued values of both the companies are given. Try to look into that thing. If yes, then apply the second method. Okay. But no exchange ratios are given, no market values are given, or the market value of one company is given, but the market value of another company is not given. One company's market value is given, another company's market value is not given. You can't apply this method, because for this method, both the company's market values should be given. Now, then you will consider the third and the last method, which is net asset method. And for applying net asset method, again you have to look whether all assets or liabilities are taken over or selected assets liabilities are taken over. If all selected assets liabilities are taken over, then apply this concept. If all assets liabilities are concerned are taken over, then all assets including goodwill, all liabilities to be deducted, and if there's a PC for preference holders is given, you have to minus it, then you will get the PC for equity holders. This method is also known as intrinsic value method. Whenever they say that PC is based on intrinsic values, but intrinsic values are not given, apply this one. So logically this method and this method are same, but in this method intrinsic values were given, and whenever the market price is not given, the intrinsic value is not given, and they say PC is based on intrinsic value, but they are not giving you, not an issue, apply net asset method, this one. So PC is based on intrinsic value, are the intrinsic value given? Method 2. Not given? Method 3, all assets minus all liabilities, you will get the intrinsic value, apply the PC. Alright guys, simple. Tell me. Sir, once again, the calculation of intrinsic value under second method. Second method. See, I'll tell you. What is the difference between method 2 versus method 3? Method 2 versus method 3. Method 2. Number of shares of transferor 1 lakh. Here also number of shares of RR 1 lakh. Method 2. Intrinsic value per share. I am saying intrinsic value, that means market value, fair value, intrinsic value per share. RR, RE. Both companies' intrinsic values are given. ₹20. 50 rupees. Calculate PC. 1 lakh. 1 lakh numbers of transferor. Currently it is valued at 20. So the total worth will be 20 lakhs. I will give you my share of 50 rupees worth. I will give you 40,000 numbers. It is a method 2. Method 3. Method 3. Number of shares are given. Intrinsic value per share. RR. Not given. Intrinsic value per share. RE. Given. 50 rupees. Now, since intrinsic value per share of under method 3, intrinsic value per share not given, you cannot apply method 2. How can you apply method 2? Tell me. How can you apply? Obviously no, na. Hana? You will not apply. So what will you do? You don't have exchange ratios. Method 1 can't apply. Method 2 can't apply. What will you do? You don't have any other choice. Method 3 only. What is method 3? Net asset. What will you do? You will calculate intrinsic value. How? All assets minus all liabilities minus PC to preference shareholders. This would come divided by number of share of RR. You get the intrinsic value of share of RR, which may be 20 rupees, 22 rupees, 25 rupees. So guys, I'm just trying to say that method 2 and method 3 are almost similar. Method 2 is a shortcut. They have given you the value. In method 3, they are asking you to calculate this 20 rupees. Guys, please understand common sense. It's a quite damn common sense only. In method 2, they have given you the 20 rupees value. In method 3, they are not giving you 20 rupees value. They are asking you to calculate this 20 rupees. Common sense, apply the common sense only. And this is the reason why I said method 2 and method 3 are same. Almost similar. Understood or not? Everyone please tell me. So it's a simple common sense, guys. You have the values, apply method 2. You don't have the values, calculate the values. For calculating the values, apply this thing. You have calculated the values. Now method 2, after calculating the values, method 2, method 3 would be same logically. Yes, of course, we are not following this one because this is asset acquired only, liability acquired only. This is different because here we are selecting only few assets and liabilities. You will get the question. Okay. Last for PC, last and final wording, last and final example with final wordings, and you have to tell me the answer. You have to tell me the answer. Last and final wording. Transferor, number of shares. Transfer number of shares 150. PC will be 3 shares for every 4 held, issued at 60. Tell me which method? Tell me which method? Of course first. Very good. And now, surprise. 3 shares for every 4 held. Okay, surprise. Cash also will be given. For remaining balance. Oh my god, what is this? Remaining? Sir, what is remaining? Now, these kind of questions are coming nowadays. These kind of questions are coming. 150 number of shares, 3 shares for every 4 held. First method, not an issue, no doubt. And cash also will be given for remaining. Sir, what is remaining? Now, this is a mix of method 1 and method 3. Whenever they say remaining balance, apply method 3, that means net asset value method. They want you to calculate the net asset value overall. How? For remaining balance, they are saying apply net asset method also, matlab method 3 also. How? First of all, can you please calculate the value of this first point? Can you please calculate the value of this first point? What is the value of the PC as per this first point? Can you please calculate? $150 numbers. I will give you 3 for every 4 and 60 rupees share. I will give you 67,50,000 value of shares. Understood? But and I will give you cash. For the remaining balance. But sir, what is remaining balance? For this value, for this particular purpose, you have to calculate the net asset value of RER. Suppose, now I'm not wasting the time. Okay, I'm not here to waste the time. Suppose you have calculated the net asset. Suppose the net asset value was 75 lakh. Suppose that you calculated the net asset value 75 lakh. How will you calculate? All assets, market value, minus all liabilities, minus payment to PC, and payment to preferential holders. If preferential holders are not given, then ignore them. Goodwill, added them. So total net asset value is 75. What is the cash value, beta? Dear, what is the cash value? Out of 75 lakh, deduct 6750. Please deduct. Net asset value is 75 lakh. Deduct 75 lakh minus 6750. What is the value? It's how much? 7,50,000. So cash is equal to 7,50,000. This is the thing. So whenever they say this thing, method 1 as well as method 3, remaining balance, that means they want you to calculate the full net asset minus the first exchange ratio, then the cash for the remaining. Understood? PC is done. Amalgamations, the most important part of the amalgamation is PC, and we did it. The amalgamations PC part is done till now. Tell me, any doubt in respect of this? I must say one thing. If you look into my notes, everything is written. No worries. Even whatever the file I have used it, I will share with you. The notes also. These are the handwritten notes. I will share with you. Don't worry. But everything is also written here, along with the examples. The important beauty of this concept note is example. If you are not comfortable, then look into the examples, then you will be comfortable. Don't worry. Okay. Ankit Kedia, cash 7,50,000. Ankit, it's a common sense, dear. I just told you. Suppose the net asset value is 75 lakh and it says the remaining balance will be cash. So out of the net worth of the company is 75 lakh, but I'm already giving you the shares of 6750. Your worth, what I would say, the total worth of this calculator is 75 lakh. Calculator is a business. The total worth of this business is 75 lakh, but I have already given you 67,50,000 number of value of shares. So the remaining I will give you the 7,50,000 cash. Simple. Arey yaar, I ordered one product in Amazon. Of rupees 5,000. The delivery boy came to me, and I did cash on delivery. I ordered cash on delivery. The product having a price of 5,000 rupees. What I did? Out of 5,000, let us say I gave him 4,000 rupees GPay. 4,000 rupees GPay and 1,000 rupees cash. Any problem you have? No, na. So in the same way, the total worth of the company is 75 lakh. Out of this, I am giving you 67,50,000 in the form of shares, and the rest I will give you 7,50,000 cash. Ankit, do you have any problem now? Simple, yaar. It's a common sense. So guys, apply the common sense. Okay, so the PC is over. So guys, PC is over. Now the next points, what we will do. Let me take the break first of all. Okay, the break of 10 minutes. I'm giving you the break of 10 minutes for, you can say, the breakfast. Okay, even I want to do my breakfast. So let me give you the break of 10 minutes first of all. After the break, what we will discuss? We will discuss some of the points on debenture holders. It will not take more than 10 minutes. And then we'll discuss the accounting treatment for transferee company, like in the nature of purchase, in the nature of merger. There are two cases in amalgamation in the nature of purchase, amalgamation in the nature of merger. So we'll discuss these two concepts. Debenture holder concept will take 10 minutes, and in the nature of purchase, in the nature of merger is the most important concept. We'll discuss that also. And at the last, if time permits, we'll discuss the books of transferor company. Okay. So these are the things we'll consider after the break. Okay. So original timing was 8:30 to 11:30, but suppose if it requires, I'll extend to 12 noon also. Don't worry. I'll extend to half an hour, 45 minutes extra. I'll consider. Don't worry. Okay. So I'm taking the break of 10 minutes and then we'll continue. All right, guys. Till now, have you understood the concept? Okay. Fine. Thank you so much, guys. Thank you so much. We'll take a break. After the break, we'll continue. All right, guys. Welcome back. Are you guys available? Am I audible or not? Okay. So, initially, while discussing with you about the PC, I told you that any payment made to creditors, debenture holders, any other party is not a PC, it's a settlement of liability. So, let us talk about the settlement of liability. In most of the questions, they will tell you that transferee company is discharging the debenture holders of transferor company. Transferee company is issuing new debentures to the debenture holders of old company, transferor company. So that is settlement of liability. But how we are going to cover up this, that we need to understand. Okay, let us understand that concept with the help of some examples. So we have some important examples. Let us understand. Look into the examples. Equity share capital of transferor 2 lakh shares, preference shares 2500, 11% debentures are also there. So now see this, what we are doing. Transferee shall discharge the following. First, cash of rupees 3 lakh to the equity shareholders. Is this a PC? Yes, it's a PC because we are paying cash of 3 lakh rupees to preference holders. Second, 3 equity shares against every 10 equity shares of transferor company. Method 1, exchange ratio method. Market value per share of transferee. Is this a PC? Yes, it is a PC. New 12% debentures to be given to the equity shareholders of transferor company of 5 lakh. Is this a PC? Yes, it is a PC. Please confirm. Are you understanding or not? Because it is also given to the equity shareholders. Tell me, have you understood this concept or not? I'm not getting your reply, guys. You have to be very active on the reply or chat, please. If you want me to be very active in the session, you have to be very active also. Okay. So these all 3 points are PC because we are giving to the shareholders. Preference shares of transferor will get equal number of preference shares in transferee issued at 10% premium. It is also a PC. Again, it's a PC. Fifth point, 11% of debentures. 11% debentures of transferor will get new 12% debentures of transferee. Is this a PC? Fifth point, is this a PC? It is not a PC. Not PC. It is not a PC, guys, because debenture holders of transferor company will get new debentures. It's not a PC. Understood? Understood? But how we are going to discharge these debentures? How we are going to discharge these debentures? Look at the point. 11% of debentures of transferor will get new debentures of transferee at a value at which same interest amount should be received. At a value at which same interest amount should be received. Same interest amount should be received. Means currently these debentures are of 15 lakhs and these are 11% debentures. So can you please tell me their current interest? Current interest amount, can you please tell me? 15 lakh multiply by 11%. It's 1,65,000. It's 1,50,000, 55,000. Now they will get new 12% debentures at such a value at which the interest amount should be same. That means the interest amount should be same at 12% debentures. At 12% debentures. Currently they are 11%, but the interest amount should be same at 12% debentures. What should be the value of the debenture? 165 divided by 12%. What should be the value of debenture? 13,75,000. 13,75,000. This is called settlement value. This is called settlement value. Understood this concept or not? 13,75,000 settlement value. You will call it settlement value. You will call it settlement value. Guys, one request is, please, whenever I ask you anything, understood or not, please do reply on time, because it will motivate me definitely that yes, I'm teaching in a right way and everybody is listening to me. It says, okay, one doubt is, sir, can you please explain once more? It says that to these 11% debenture holders, transferee will give them new 12% debenture holders, 12%, 1% extra. At what value? They have not given the value. That for 15 lakh, I will not give you the 15 lakh. The value is not written. Of what value I will give you? The value should be at which the same interest should be received. Like, this is the value, 13,75,000. If you do 12%, the same interest 165 would be issued. Okay. Okay, understood, guys? Tell me. Sir, why don't debentures to the shareholders of 5 lakh not taken in the PC? No, it should be taken in the PC. I think it is a misprinting. Don't worry, it should be taken in the PC. 5 lakh should be taken, dear. And I think the total is same. The total is fine. It's 3 lakh plus 1080 plus 5 lakh plus 275. Total is 2155 along with 5 lakh, dear. Before asking the doubt now, please apply the common sense. It's just a misprinting because the total is fine. Apply the common sense directly also. Okay. So it's a PC. Next. Example 11. Now come to the point. Example 11. One different example. Transferor has an outstanding 7% debentures of 12 lakh. Transferee will settle these debentures at 20% premium. Now, the 12 lakh rupees debentures will be settled at 20% premium. Please add 20%. Please do it. Do it fast. And reply me. 12 lakh plus 20% premium. 12 lakh plus 20% premium. Transferee will settle these debentures at 20% premium. What is the value? 12 lakh plus 20% premium. What is the value? The value is 14 lakh 40,000. So the settlement value, see, the settlement value is 14 lakh 40,000. Now how I will discharge? 14 lakh 40,000 I can pay in the cash. I can pay in the form of cash, or 14 lakh 40,000 of the value of debentures, new debentures. So it says by issue of new 8% debenture at 25% premium. If I assume the face value of 100 rupees, so the issue price of debenture would be 125 rupees. Would be 125 rupees. So this I will settle. This 1440. This 1440 I will settle in the form of debenture. One debenture I will issue at 125 rupees. I will issue of new debenture 25% premium. Matlab, I will issue the debenture at 125 rupees. So how many number of debenture I will give you? 11,520. 11,520 number of debentures I will give you. Understood this example? These are not PC. These are just the settlement of liabilities. These are settlement of liabilities. Okay. Do it second. Do it the next one. 9% debentures of rupees 10 lakh to be settled at 20% premium. Please, again, 10 lakh settled at 20% premium. Do it fast. 10 lakh plus 20%, it's 12 lakh. So the settlement value is settled at 20% premium. So the settlement value is 12 lakh. But how I will discharge this 12 lakh? Cash? Yes, I can give the cash. Or new debenture. By issue of new 10% debenture to be issued at 25% discount. Earlier, there was a 25% premium. But now, I will issue the new debenture at 25% discount. That means the issue price would be 75 rupees. The issue price would be 75 rupees. Tell me how many debentures I will issue. 12 lakh divided by 75. 16,000 number of debentures I will issue. 16,000 number of debentures I will issue. 16,000 number of debentures I will issue. But the settlement value is 12 lakh. Because 16,000 number of debentures I will issue at 75 rupees. So the value will be 12 lakh. Settlement value is 12 lakh. Last. 6% debentures of 720 to be discharged at 10% discount. Now, instead of premium, I will discharge at discounted price. Matlab 720 minus 10%. What is the settlement value? Dear, initially you were doing 10 lakh to be settled at 20% premium. So you did plus 20%. But now 720 to be discharged at 10% discount minus 10%. Do it. Do it fast. The settlement value is 648. The settlement value is 648. Now, how this settlement value I will discharge? Cash? Yes, can be cash or any other debenture or any other equity share. See the question. By issue of equity share. Oh my God, it's not a PC. It's not a PC because I'm giving share not to the shareholder. I'm giving share to the debenture holder. It's not a PC. It's not a PC. Understood or not? So I will give the share at 12 rupees per share. Okay, so settlement value 648 divided by 12. How many number of shares I will issue? I will issue 54,000 number of shares. Have you guys understood this concept? So this was settlement of debenture holders. Tell me. Understood, guys? So have you understood this concept? Simple. So debenture holder settlement is also done. Now, the next part and most important, accounting. Journal entries and balance sheet preparation. Accounting for in the nature of merger and in the nature of purchase. Amalgamation in the nature of merger and amalgamation in the nature of purchase. Amalgamation in the nature of merger and amalgamation in the nature of purchase. So I'm on page number 214. Amalgamation, types of amalgamation. Types of amalgamation. So there are two types of amalgamations in the nature of purchase, in the nature of merger. Now, merger has 5 conditions. We'll discuss that. Don't worry. But before understanding those 5 conditions, what is this? How easier it could be, or how we can remember about purchase and merger? What is the simplest point to remember? Simple. The dominance factor. If I acquired your business and I can control your business, I can dominate, I can take all the decisions, I can dominate you. I controlled your business. I acquired your business, but I don't want you to come into my business. Means your shareholders are not becoming the shareholders of my company. I given the PC to them in the form of cash. I retained the entire control with me only. The dominance factor. If the dominance is involved, if the transferee can dominate over the transferor's business, it's amalgamation in the nature of purchase. So I'm just telling you the basic difference between purchase and merger. Apart from accounting and all, how will you identify it as a purchase or merger? Under purchase, the transferee has full dominance, full control over the transferor business. And that control is retained by not giving them PC in the form of shares. I will deliberately give you the PC in the cash so that your shareholders will not become the shareholders of my company. This is a dominance. So it's an amalgamation in the nature of purchase. But in the amalgamation in the nature of merger, there is no dominance at all. There's an equal control with both the shareholders. After amalgamation, your shareholders and my shareholders will both control the company. We will both manage the company. We'll both take the common control. We'll both take the common decisions. So whenever there's a common decision making over the business, there's a common control, it's a merger. It is a merger. Understood this concept or not? Understood this concept or not? Tell me guys, understood this concept or not? All right. So this was the basic difference, but as far as accounting is concerned, what is the difference? Under amalgamation in the nature of merger, under amalgamation in the nature of merger, there are 5 conditions. 5 conditions. If such 5 conditions are satisfied, we'll call it amalgamation in the nature of merger. Condition number 1. All assets and liabilities must be taken over. All assets and liabilities must be taken over. Condition number 1. All assets liabilities must be taken over. Now tell me, if you are calculating PC as per this method, you acquired selected assets, you acquired selected liabilities. Tell me, which amalgamation is this? In the nature of merger or in the nature of purchase? Of course, in the nature of purchase. Because for the merger, you have to consider all the assets and all liabilities. But that doesn't mean, wait. That doesn't mean that this is a merger always. Please, mind it. All assets and all liabilities are taken over. That doesn't mean that this is a merger always. This could be merger, this could be purchase. Please. Okay. So first condition. Second condition. All assets liabilities must be recorded at same book value. Recorded at same book value. Matlab, transferee shall record all the assets liabilities at book value only. We will record the assets liabilities at book value, not at market value. Again, mind it. Here, for the recording purpose, we will use the book value. Please do not link this point with PC. In PC, I told you that PC is always based on market value. But mind it, do not link this concept with in the nature of merger. Sir, what you want to say? I just want to say that in the amalgamation in the nature of merger, transferee has to record the asset liabilities at book value only, even though the purchase consideration is calculated at market value. Even though you are following merger, even though you are recording the asset liabilities at book value, PC will always be calculated at market value. PC calculation is totally different and accounting is totally different. Do not link both the points. How? As a student, I could say, oh, the PC is recorded, the PC is calculated at market value. That means it's a purchase. Not an issue. No, not necessary. Oh, I calculated the PC at book value. That means it's a merger. No, please do not link PC with the accounting. Are you getting my point? Are you getting my point or not? Guys, calculating PC is a different thing. and recording the assets and liabilities is a different thing. Again, same common sense. I will give you the PC based on the real market values now. Forget about the recording. These are the requirement of AS14. But how much PC I will give you? Who is AS14 to tell me? Who is AS14 to tell me that you have to calculate the PC by book value, or you are using book value, that means calculate the PC by book value? Who is AS? Who are you? I am asking AS14. Who are you? Who are you to tell me that I have to calculate the PC by book value only? You will only tell me the accounting treatment. You are nobody. You are nobody to tell me that I have to calculate the PC by book values. Are you guys understanding or not? PC is a consideration which is calculated with the mutual consent of transferor and transferee. Okay, so AS14 will not give you the AS14 will not give you the any accounting method for PC or any method to calculate PC. Okay, so do not say that, sir, we are following amalgamation in the nature of merger, and sir, in the nature of merger, we record the asset liabilities at book value. Hence, sir, calculate the PC at book value. No, not at all. Not at all. Have you understood this thing or not? Because I knew this, that maximum students are getting confused with the same treatment. Why I am concentrating on this very much, or why I am emphasizing on this, because I know every one of you, most of you are getting confused because of this thing. Do not link PC with the method of accounting. Method of accounting is given under AS14. PC calculation is not given under AS14. PC calculation is not given under AS14. Okay. So what is the moral of the story? Even though I am taking over all assets liabilities, even though I am recording the same assets liabilities at book value, but I can calculate the PC at market values if given in the question. But yes, suppose if the market values are not given in the question, then we don't have any other choice to take the book values. So merger, 5 conditions: all assets liabilities must be taken over. Second, all assets liabilities must be recorded at same book value. Third, equity shareholders of RR holding at least 90% equity shall become shareholders of transferee. So minimum 90 equity shareholders holding at least 90% of the equity shares must agree to become the equity shares of transferee. I told you that in the merger, there's a common control. There is no dominance of transferee. I told you earlier. This will prove that yes, there's a common control. Why? Because if I want to do merger, if I want to make a common control, I have to offer them the equity shares. I have to offer them the equity shares only. I have to provide the PC in the form of equity shares only, so that they will become the equity shares and take the decisions along with me. So for common control, equity shares or equity shareholders of RR should become the equity shareholders of RE for common control. Understood or not? Fourth, PC must be discharged to equity shareholders of RR in form of equity shares only. Yes, in merger, the PC should be issued in equity shares only. You cannot give the cash, you cannot give the debentures, you cannot give any other thing to the equity shareholders. To the equity shareholders of Transferor company, you have to give them the PC in the form of equity shares only. Yes, for fraction, we can give the cash. Cash is allowed for fraction only. Cash is allowed for fraction only. Cash is allowed for fraction only. So if I would ask you, if I would ask you that in this question, in this debenture question, you remember the cash was being given to, cash of rupees 3 lakh was given to equity shareholders. Equity shares were being also given to the equity shareholders and debentures were also given to the equity shareholders. Tell me, here we are giving the cash, we are giving the PC in the form of cash also, in the form of equity shareholders, equity shares also, in the form of debentures also. Tell me, which amalgamation is this? Is this a merger or purchase? Which amalgamation is this? It's a purchase because we are giving cash. We are giving debentures to the equity shareholders. So, as far as merger is concerned, you have to pay the PC in the form of equity shares only. In the form of equity shares only. Fifth, business of RR shall be carried on by transferee continuously. So transferee should carry on the business, the existing business of RR after the amalgamation. This is a quite simple point, not an issue. So these are the 5 conditions of amalgamation in the nature of merger. These are the 5 conditions of amalgamation in the nature of merger. All assets, liabilities must be taken over. Okay, all assets, liabilities must be taken over. Whenever I say all assets, liabilities, here you can write except fictitious assets. Fictitious assets. See guys, fictitious assets are not actually assets. Fictitious assets means underwriting commission, unamortized underwriting commission, or not yet written off. It is shown under the asset side of the balance sheet. Preliminary expenses not yet written off. Share issue expenses not yet written off, shown on the asset side. These are not actually asset. These are fictitious assets. So if we are taking over all assets and liabilities but not taking over fictitious assets, then also it's a merger, because fictitious assets are not actually the assets. Okay. Okay. So all assets, liabilities must be taken over, must be recorded at same book value, irrespective of the PC calculation. Irrespective of the PC calculation. Irrespective of PC calculation. Means even though you calculate the PC at market value, you should record the assets, liabilities at book value if there's a merger, amalgamation in the nature of merger. Equity shareholders will be should become the equity shareholders of RE. They should be issued equity shares only in the form of PC, and the same business to be carried on. Guys, any doubt in this? Any doubt in this? No? Okay. Other than that, okay, the points are done. Now, accounting for amalgamation. In the nature of purchase, in the nature of merger. In the nature of purchase, in the nature of merger. Okay. So, PC as per market values. PC as per market values. In both cases, PC as per market values. PC, any form, cash, equity, preference, debentures. PC to equity shareholders, only equity. Only equity shares. Recording of assets, liabilities may be at market values if given. Otherwise, book values. because it is a purchase. But recording of asset liabilities at book values only. Okay. One more thing. Reserves and surplus of transferor need not be recorded by transferee. Transferor balance sheet contains general reserve, P&L, security premium, need not to be recorded by transferee. Except statutory reserve. But yes, statutory reserves like investment allowance reserve, export profit reserve, it should be maintained. It should be recorded by transferee company. To be recorded by transferee company. Here, all reserves and surplus of RR should be recorded by RE. All reserves and surplus of RR should be recorded by RE. RE has to record all reserves and surplus of RR in the merger. See, I told you that in the merger, there is no dominance. There's a common control, common decision making. But in purchase, there's a dominance. So, when you follow in the nature of merger, it's a common control. Your company shareholders, my company shareholders will become combined and they will take the decisions together. Common control in the merger. Your shareholders, my shareholders will be merged together and take the common decision makings. So the idea is, if there's a common control, then your balance sheet, my balance sheet, your balance sheet before amalgamation, my balance sheet before amalgamation should be combined at the same values. Why to record the market values? The basic idea is that when there's a common control, then just merge the balance sheets now. Your balance sheet plus my balance sheet equal to balance sheet after amalgamation. Simple. So this is the idea. This is the thought process of AS14. AS14 says when there's a common control, then why to change the values? Let the values be same now. Let the values of balance sheets before amalgamation should be same after amalgamation. This is the basic structure you have to understand as far as amalgamation in the nature of merger. But when there's a dominance, like I purchased you, when there's a dominance, so definitely in this kind of amalgamation, the asset liability could be at market value because I purchased it. But in merger, we haven't purchased, we just merged. So here, the basic idea was to merge the balance sheets at same book values. But here, idea was not to merge the balance sheet. Here I purchased from you. So if I purchase from you, I will record it at their actual market values. I hope you could understand bit more the conceptual understanding. Say yes or no. So all reserves or transferors should be recorded by transferee. Here we apply pooling of interest method. Sir, what is that? Method of accounting. Method of accounting. Here we apply. Here we will apply purchase method. Here we apply purchase method. Understood, guys? So PC, same. Market value. PC in any form. PC to equity shareholders, only equity shares, cash for fraction only. Recording of asset liability may be market value if available, otherwise book value. Only book value. Reserves of transferor need not be recorded in the books of transferee except for statutory reserves. Reserves of transferor all to be recorded in the books of transferee. Merger, basically the merger. In merger, you just combine the balance sheets simply. So this was the basic idea of amalgamation in the nature of purchase, amalgamation in the nature of merger. Now come to the journal entries. Come to the journal entries. Okay, accounting entries. Accounting entries. So let's understand the accounting entries fastly. Okay, accounting entries. See, this is a purchase. This is a merger. Now, the first entry is quite simple. Business purchase account debit to liquidator of transferor company. Why liquidator? Because transferor company is getting liquidated. So you will discharge the PC. You will hand over the PC to the liquidator, and liquidator will discharge it to the shareholders. So business purchase account debit to transferor. This entry should be at the PC amount. Same entry for the merger. Business merger account debit to liquidator of transfer company. You do business merger, you do business purchase, it is same, no doubt. It is same. So first entry is same for both PC. Business purchase to liquidator PC. First entry is done. If you have any doubt in the first entry or subsequent entries, please do ask immediately. Second point. In the nature of purchase, what will you do? Sundry assets account debit at agreed value. Agreed value could be the market value, could be the book value. Two liabilities. It is the payable value. Now you can write here the settlement values. Do you remember the settlement value word? We were using it half an hour back. You remember the settlement value word? Where we were using it? Settlement value. Debentures. We did so many examples, and we frequently used to calculate the settlement value. This is the settlement value. Okay. So assets at market value, book value. Liabilities at settlement value. Okay. If available, or book value. To business purchase, PC. The business purchase you have debited. Now the business purchase you are writing off because you have recorded the asset liabilities. So after this, after you recorded the asset, after you recorded the liabilities, and after you de-recognize the business purchase, there's a difference. The difference would arise. Either it will be goodwill or capital reserve. Either the difference would be goodwill or capital reserve. Simple. In the nature of merger, second entry. All assets. You remember? In the merger, we record all asset, but in purchase, not necessary. So we record all asset at which value? At book value. We record all liabilities either at book value or payable value. So or book value or settlement value if available. Settlement value if available. Here also settlement value. If the debentures are settled at 20% premium, 10% discount, the settlement value you record. Okay. To business purchase, the PC value. To reserves and surplus. See the difference. All reserves and surplus of transferor should be recorded by transferee. And after recording the reserves, if there is any difference, do not charge to goodwill or capital reserve. Transfer the difference either in general reserve or P&L. Rather, I would say P&L only. Only P&L. Rather, I would say P&L. Guys, have you understood this concept? Tell me, have you understood this entry? So all assets recorded, all liabilities recorded, business purchase reversed, PC reversed, reserves and surplus all, whatever the difference arise, P&L. Simply P&L. Done? Okay, second entry done. Third entry. I told you that you hand over the PC in the hands of liquidator. Okay, now time to hand over. This was a due entry. Now, when you discharge the PC to liquidator, what entry you will pass? Liquidator account debit to what PC you are giving? You may give cash, you may give equity shares, you may give preference shares at a premium, without a premium, debenture, whatever you will give. But in the case of merger, liquidator account debit to cash, maybe for the fraction only, to equity share capital, to preference capital. Sir, why to preference capital? In the merger, we only give the PC in the equity. We only give the PC in equity share to the equity shareholders. But as far as preference shareholders are concerned, we may give the PC to the in the form of preference shares. So this is the entry of payment of PC. I hope you must have cleared. If any doubt you have, please ask me. Anju, sir, these entries are to be recorded in the books of buyer, right? Dear, of course. Of course, dear. I'm not talking about the transferor company. Of course, na dear. What I'm doing? Business purchase to liquidator of transferor. How the transferor will do transferor entry? How the transferor will do business purchase? How transferor will apply business purchase, dear? Please. Third time I'm saying, everybody, apply common sense. The amalgamation topic is full of common sense. Full of common sense. Okay, so these are the three entries. Fourth entry is quite simple. Cancellation of receivables and payables. Cancellation of receivables and payables. Common debts like transferor and transferee. Both are common debts of each other. Like in my books, you are my debtor. In your books, I am your creditor. So common debts to be cancelled off. Common debts to be cancelled off. Payable account debit to receivable. Okay. Entry clear? Entry clear? Now, for understanding the next entry, I would take earlier examples of debentures. You remember this page? In this example, the settlement value was 13,75,000. In my second example, the settlement value was 14,40,000. In this example, the settlement value was 12 lakh, even though the debenture value was 10 lakh earlier, but the settlement value was 12 lakh. Even though the debenture value was 15 lakh earlier, but the settlement value was 13,75,000. Even though the debenture value was 12 lakh earlier, but the settlement value was 1440. In my next example, the settlement value was 6,48,000, even though the debenture value was 720. So settlement value. What I'm actually trying to say, I'm saying that whenever you do the second entry to liabilities, here you can do to debenture holders at settlement value, means 1375, 1440, 12 lakh, 648. You do the entry at this value, settlement value. Suppose you did 1375. Now in the fourth entry, see the fourth entry. In the fourth entry, liability account debit 1375, because earlier you credited the debenture holder at 1375. Now liability account debit 1375, and you are giving them new debenture of 1375. New debentures of 1375. Suppose earlier you did 1440 of our this example 1440. So in the second entry, you do two debenture holders 1440, and then when you will settle them, the same credited debenture holder will be debited 1440, and you are giving them new debenture 11,520. 11,520 new debentures. So 2 debentures, 11,520 multiplied by 100 at face value, and the rest is security premium, because you are issuing the debentures at 125. So 25 will be the premium. Have you understood this entry, settlement entry? Now you can look into the settlement entries always. You can look into the settlement entries in every example. I just want to say that in the second entry now, always record the debenture holders at settlement value. I'm just saying this. And then settle them like this. Either it is in the nature of purchase or it is in the nature of merger. Either it is in the nature of purchase or it is in the nature of merger. Okay. So this entry is also done. Next. If transferee company is making any expenses or payment of any expenses on behalf of transfer company, or making any or paying any unrecorded liability, settling any unrecorded liability, what we will do? See, payment of expense, payment of unrecorded liability will be the cash, in cash. So cash account will be created either here, either here. What is to be debited? Capital reserve or goodwill in case of purchase. Here, general reserve or P&L. So because in the second entry, the difference was transferred to goodwill or capital reserve. Here, the difference was transferred to general reserve or P&L. So you do this. Whenever you incur any expenses or pay any unrecorded liability, you will either debit the capital reserve if you have available, otherwise goodwill to cash. Here, you will do P&L account debit to cash. Any doubt in this entry? Any doubt in this entry? Okay. Last entry. No, not the last. Okay. For creation of statutory reserves. For creating statutory reserve. I told you here that reserves of transferor need not be recorded except statutory reserves. So for creating a statutory reserve, you have to pass this entry, amalgamation adjustment reserve, to statutory reserve. Now, amalgamation adjustment reserve should be shown as a separate line item under the head reserves and surplus. It is to be shown under reserve and surplus as a negative figure. As negative figure. But in the nature of merger, no need to do this entry. No statutory reserve to be created separately, since they are already recorded in the second entry above. In the second entry above, you already recorded the transfer reserves and surplus of transfer company. So of course, no need for this entry. Guys, understood or not? Last, unrealized profit. Unrealized profit. Sir, what is unrealized profit? I will discuss this. This and this with the help of some examples as well as some entries. Unrealized profit elimination on unsold stock. Okay. You can call it stock reserve, SR, stock reserve. Now, what journal entry we will pass always? General rule. Reserves and surplus debit to stock. This is the journal entry we'll pass. But there is exceptional rule. There is exceptional rule also. There is one exceptional rule also. There is one exceptional rule also. We will pass goodwill or capital reserve account debit to stock. See, stock is common. Okay. General rule is you will debit reserves and surplus. Exceptional rule is you will debit goodwill or capital reserve. Goodwill or capital reserve. Now, when you apply this exceptional rule, when there is a upstream transaction plus amalgamation in the nature of purchase. When there's an amalgamation in the nature of purchase and there's an upstream transaction. What is upstream transaction? What is upstream transaction? Goods sold by RER to RE. Goods sold by RER to RE. So, for this unrealized profit elimination, always pass this entry. But if there's an upstream transaction, including amalgamation in the nature of purchase, both conditions should be passed. Then, instead of reserve and surplus, you will pass entry goodwill or capital reserve. I know you haven't understood this concept properly because logically I haven't discussed what is unrealized profit and what is unsold stock, why we are doing this. I haven't discussed this. Don't worry. I will come to the conclusion. I will come to the logical points also with the help of the example. But what the important thing is, first of all, learn the entries. It is quite important to learn the entries first of all. Learn the general rule and learn the exceptional rule. Okay. Now, sir, what is upstream? What is downstream? See, Transferee, the buyer, is a bigger company. Is a big one. And Transferor is a smaller company. So I kept Transferee company on the higher side. And I kept Transferor company on the lower side. Because it's a small company. No? It's a seller. So the buyer is purchasing this company. So definitely this is a big company. So it is on the higher side. It is on the upper side. And Transferor, it's on the lower side. Because it's a small company. It's on the lower side. So how to identify at upstream or downstream? Simple. Now see the goods flow. Goods are transferred by RE to RER. The flow of goods. The flow of goods from RE to RER. It's getting downward. RE to RER. It's a downstream transaction. It's a downstream transaction. Goods sold by RE to RER. It's a downstream transaction. Goods sold by RE to RER. Now see the opposite. Goods sold by RER to RE. See the flow of the goods. See the flow of the goods. See the flow of the goods. From RE to RER, goods are sold upward. The flow is getting upward. It's a upstream transaction. Sold by RER to RE. Now tell me, have you understood this point? Not the concept, only this point. Only this point have you understood this? Or not? All right. Now, with the help of some examples, I will discuss. So come here. It's a page number 230. Example 19. Now I am taking some examples. Okay. A Limited sold goods costing rupees 120 to B Limited at 150. Now how much profit has been made? 30,000 profit. 120 costing of goods sold to B at 150. 30,000 profit was made. After some time, A Limited acquired the business of B Limited. A Limited acquired the business of B Limited. A Limited acquired the business of B Limited. So A becomes a re. B becomes a transferor. Now who sold goods? Transferee sold goods to transferor. So tell me, which transaction is this? Downstream or upstream? Guys, you are wrong. Amal, Lakshmi, Simran, why you are telling me up? It's not upstream. It's a downstream transaction. A sold goods to B. A sold goods to B. A is a transferee. Re is a bigger company. The flow of goods is from re to R. From re to R. Look at the flow, na? What I told you. Re is a bigger company. A sold goods to B. A sold goods to B. So it's a downstream transition. Okay? It's a downstream transition. So since it's a downstream transition, general rule or exceptional rule? Tell me, general rule or exceptional rule? No exceptional rule, because in exceptional rule only will apply when there's a upstream transition as well as when there's an amalgamation in the nature of purchase. Otherwise, general rule. What is the entry under general rule? Reserve and surplus account debit to stock. Sir, what is the basic structure, basic concept? The concept is the stock should be recorded at cost only. The important concept is the stock should be continued at original cost. So we sold the goods of 120 at 150. So the original cost is 120, but we sold it at 150. Inventory of B includes 30,000 goods purchased from A. Now what is the concept? Cost and sale price. Total goods. Total goods of 120 cost. Sold at 150 selling price. Sold at 150 selling price. Out of which unsold goods. Unsold goods. So B's inventory. The inventory B have. The total inventory purchased by B is 150. Total inventory purchased by B is 150. Out of which B has 30,000 of inventory which is not yet sold, which is still unsold. That means B totally purchased 1,50,000 rupees of inventory, but out of which still 30,000 of inventory is still unsold. So tell me, what is the original cost of that inventory? Cross multiplication. What is the original cost of that inventory? Cross multiplication. Please do it. Please do it. Cross multiplication. If the cost is 120, selling price is 150, unsold inventory is having 30,000, what will be the cost? The cost is 24,000. The cost is 24,000. So what is the unrealized profit? The unrealized profit means such stock which is not yet sold, should be shown at 24,000 instead of 30,000. So the 30,000 of inventory, out of the 30,000 of inventory, you have to eliminate 6,000 rupees of unrealized profit. You have to eliminate unrealized profit, elimination of 6,000. What entry you will pass? When you will eliminate the profit is appearing in the reserve and surplus side. So reserve and surplus to be debited for elimination, and stock which is appearing at 30, now you will reduce it by 6,000. Now understood the concept? Please tell me. Tell me, now understood the concept? Why this entry, sir? Because you are eliminating the profit. The profit is appearing in the reserve and surplus. So you are doing reserve and surplus debit. and the profit is also a part of the stock. So stock you are crediting. Simple. The concept is quite simple. But sir, what is the concept of this exceptional rule? Why goodwill and capital reserve? Because in the nature of purchase and in the upstream transaction, see, Ankit Kedia, I'm reading the comments also, but please have some respect, have some sense, please. Earlier also, you have given some comments. I know you need some full questions. I know, Ankit, I know you are waiting for the questions, but let me decide when I will start the full question. Ankit, I am reading your comments, but it's now quite irritating. Ankit, you are irritating me actually. Okay, so let me decide when I will take the full question. So I am not expecting further points like this. Sir, need further full question. Earlier also 2-3 comments of you were disturbing me. Okay. So I am not teaching you only. Here in this entire session, you are not only here. I am not responsible only for your concepts. I am responsible for everyone. So don't teach me when I start and when I not. Okay. I think you are here only just to think that, sir, please give us 2-3 questions. Please. You are irritating actually. Alright. So there is unsold stock. There is unsold stock. There is unsold stock. So guys, logically, if the stock is not sold, then in such stock, there's a profit earned by transferee from transferor or vice versa. Because basically in the upstream or downstream transition, one company has sold goods to another company. So the one company who has sold goods must have earned the profit from another company. But the problem is another company has not yet sold such a stock further. If the another company has not sold the stock further, such a stock becomes the unsold stock. And in such a stock, there's a profit which is earned by another company which is unrealized logically. So we have to eliminate it. Now for exceptional rule, why we are doing goodwill or capital reserve? Why we are doing goodwill or capital reserve? Because look at the conditions. Under upstream transition, upstream matlab here, this is a transition. Who has earned the profit? Who has earned the profit? The transferor has earned the profit. The transferor has earned the profit. Means the profit is appearing in the reserves and surplus of the transferor. And in the amalgamation in the nature of purchase, the transferor reserves and surplus need not be recorded. The transferor reserve and surplus need not be recorded. So logically, in the amalgamation in the nature of purchase, I haven't recorded the reserves and surplus of transferor, but the transferor has earned the profit. So I cannot do reserve and surplus account debit because transferor has earned the profit, but I'm not recording the reserve and surplus of transferor. So this is the reason I'm doing goodwill account or capital reserve account. This is the basic concept of this example. Okay. Now come to the same example. We have to eliminate 6,000 rupees. Have you understood this? Okay. Now there is one tricky point in this unrealized profit question. That tricky point will be covered in example 20. Very, very tricky point. There is one very, very important and tricky point is in the example number 20. Look at the example 20. Again, there's a downstream transition, not an issue. Case 1. Transferee sold goods to transferor costing 5 lakh at 750. So what will you do? See, this is the total goods. 5 lakh. Total sale 750. Simple. So at a cost of 5 lakh, the sale was 750. What was the total profit? 250. Okay. In the balance sheet of transferor, total inventory is appearing at 12 lakh. Don't look at this. We need to actually check how much inventory was from transferee wala inventory kitna tha? Like transferor has total inventory of 12 lakh, but out of which how much inventory came from transferee, which includes goods from transferee was 3 lakh. So total inventory sold 750, out of which we still have 3 lakh rupees of inventory. we still have 3 lakh rupees of inventory. So tell me, overall sale was 750, overall profit was 250, but unsold item was 3 lakh. So what should be the profit? The profit should be 1 lakh. The profit should be 1 lakh. We have to eliminate unrealized profit to be eliminate 1 lakh. We have to eliminate 1 lakh. What entry we have to pass? Reserve and surplus to stock 1 lakh. Guys, case 1 clear? Tell me guys, case 1 clear? Okay, but case 2 is very interesting. Same as case 1, but inventory is taken over at 15% less than book value. This is a tricky point. This is a tricky point. And students like Ankit Kedia should understand that why I am discussing this point in detail. Students like Ankit Kedia should understand that yes, there is something very quite important, because whenever these points will come in the full question which they were demanding, they will never be able to solve that points. But they can't understand this thing. They will understand, they will just demand their things. Sir, do this, do this, do this, do this. Anyways, same as case 1. Inventory is taken over at 15% lesser than book value. 15% lesser than book value. Now, 15% lesser than book value. I have taken over the inventory at 15% lesser than book value. See, what is the idea behind eliminating the profit? The idea is simple. I need to show the stock at original cost. If I would say that in this 3 lakh rupees of unsold stock, the profit is 1 lakh. So logically the cost is 2 lakh. The cost is 2 lakh. So my ultimate intention is I taken over the inventory at 3 lakh. The inventory of transferor now I taken over all the assets of transferor. I taken over all the assets of transferor. So I taken over the inventory of transferor at 3 lakh, but I need to record the inventory at 2 lakh. Hence I reduce the stock value of 1 lakh. This is clear? Then I will come to the second point. The basic idea is I am taking over the stock at 3 lakh, but I am reducing rupees 1 lakh so that the stock should be at 2 lakh. The clear cut? But now see, the inventory is taken over at 15% less than book value. So tell me, I taken over the inventory now not at 3 lakh, but 15% lesser value. Please do this 15% less. 3 lakh minus 15%. 3 lakh minus 15%. What is 3 lakh minus 15%? 255. Now tell me, I taken over the inventory at 255 and my ultimate intention to record the inventory at 2 lakh. Now instead of 1 lakh, I will only eliminate 55,000 rupees of stock reserve. Only 55,000 of stock reserve I will eliminate. Stock reserve account debit, reserve and surplus account debit to stock reserve or to stock 55,000. 55,000. Have you understood this concept? Let me repeat it once again. My ultimate intention to show the inventory at cost of 2 lakh. In the first case, I first taken over the net assets, means taken over the unsold inventory at 3 lakh. And 3 lakh inventory, I am reducing it by 1 lakh because I want to show it at 2 lakh. In the second case, I taken over the inventory at 15% lesser value. So what was the inventory value? 3 lakh rupees was the inventory value in the books of the transferor, because transferor has purchased it. So I taken over the inventory at 3 lakh less 15%. So I taken over the inventory at 2,55,000 guys. I taken over the inventory at 255. So do I need to reduce 1 lakh again? No. I already taken over the inventory at 255 and the inventory should be at 2 lakh only. So here I will record the 55,000 of unrealized profit. That is a reduction. Tell me, have you understood this concept? This is the important point. 1 or 2 questions are having these type of adjustments. All right. Okay, guys. So all the concepts are done. All the concepts are done. Okay. Some miscellaneous, not so much important concepts are there, which you can read by yourself. These are very simple concepts. Don't worry. Like how to calculate goodwill, which method to be used for the goodwill, and settlement value, and all these are the very similar, important but less important, and small concepts are there. You can read them by yourself. So this was the question this was the concept on amalgamation in the nature of merger and in the nature of purchase. Before heading to the question, I will discuss books of Transferor company also. Okay, books of Transferor company also. So if you guys have any doubt, you can ask me. If you guys have any doubt, you can ask me. Tell me. And give me 2 minutes only. Give me 2 minutes. You guys can ask your doubts. Alright guys. Anju, sir, can you please explain once more the stock taken over at lesser value than book value while doing some questions? Simple. See. Here's the transferor. Transferor in its balance sheet. Transferor in its balance sheet showing stock of rupees 5 lakh. Okay. Transferee took over stock at 10% lesser value. Transferee took over the stock at 10% lesser value. Okay. Second point. Above stock of 5 lakhs includes goods purchased from RE. Means RER's stock includes some goods purchased from RE earlier. RE. Whose value is 1 lakh 20. So this 5 lakh rupees of stock includes 120 value of unsold stock purchased from RE. The original cost of these goods were 1 lakh. Now what was the original cost? 1 lakh. So logically, prima facie, what is the unrealized profit? 120 minus 1 lakh. The unrealized profit is 20. Total unrealized profit is 20. Logically, the unrealized profit is 20 now. Tell me, yes or no? But we taken over the stock of 5 lakh, not at 5 lakh, at 10% lesser value, means at 90%. So if I means transferee, I'm taking over this stock at 90% of the value, and this stock includes this 120 also. So if I'm taking over this stock at 90% value, so logically this 120 is also taken over at 90% value. So stock is taken over at 90% value. Hence, 5 lakh stock is taken at 450, and 450 includes, if 5 lakh rupees of stock includes 120, but I haven't taken over this 5 lakh at 5 lakh, I taken over this 5 lakh at 90%. So tell me, this 450 includes 120 or 90% of 120? Everyone, anyone can tell me the answer. If 5 lakh includes 120, but I taken the stock at 450 only. I taken the stock at 450 only, 90%. So 120 also at 90%, na? So 120 into 90%. I taken the, which includes 1,08,000 of unsold stock. 1,08,000. So now tell me, in my second entry, you remember the entries I did? In my second entry, sundry assets account debit. In my second entry, sundry assets account debit, stock account debit, what value I will record? 450. So logically, if I am recording the stock at 450, so such stock includes 1,08,000. So I recorded the stock at 1,08,000. And what is the actual cost? The actual cost is 1 lakh. So tell me, do I need to eliminate 20,000 still, or only 1,08,000 minus 1 lakh? Only 8,000. Tell me, how much stock reserve I should eliminate? Is still 20,000 in stock, or only 8,000 in stock? Only 8,000 stock. Only 8,000 I need to eliminate, because my ultimate target is to show the stock at real cost. At real cost. Eliminate 8,000 only. Simple. Anju was there, no? Yes. Anju, now understood or not? And everyone. Books of transfer. It's quite simple. Books of transfer company are quite simple. What it says, see, books of transfer company. Transfer company is getting liquidated. So what is the ultimate target? Ultimate target is close all assets, all liabilities. The ultimate target is close all assets, all liabilities. Ultimate target is close all assets, all liabilities. Okay, even all capital and all. See, if you consider the balance sheet of transferor, the balance sheet of transferor must have building, plant and machinery, debtors, inventory, cash, bank. Okay, and it may have equity capital, reserve and surplus, preferential capital, reserve and surplus, and liabilities. So what is the objective? Objective is to empty the balance sheet, to close all assets, all liabilities, all accounts, empty the balance sheets. Objective is to empty the balance sheet. Okay, this is the objective. So point number 1, transfer all assets and liabilities to the realization account. What I will do? I will prepare one account called realization account. I will transfer this, cash bank wait. I will transfer this to realization account. All the assets to be credited to realization account, to sundry assets. Of course, book value, because I'm closing the assets liabilities. I'm closing the assets liabilities of their book value by sundry liabilities book value. Sir, what about cash and bank? See, fourth point, cash and bank. If taken over, then for it to realization account, otherwise make it separately. We have to check whether such cash and bank account is taken over by transferee company or not. If it is taken over, then to be transferred to realization account. If taken over by re. But suppose cash bank account is not taken over, then you will prepare the cash bank account separately. You will prepare the cash bank account separately, and here you will write the balance, opening balance of cash as per the balance sheet. If not took over. So what we did? Building, plant, debtors, investments, cash bank, everything was either in the relation or separately as the cash account. Liabilities in the relation. Building, taken over or not taken over, transfer to relation. Plant and machinery, taken over or not taken over, plant transfer to relation. So every asset except cash, taken over or not taken over, close to relation. Liability, taken over, not taken over, close to relation account. Cash account, taken over, close, not taken over, make it separately. Now these three remaining, you will prepare preference shareholder account, you will prepare equity shareholder account. Transfer preferential capital to preferential shareholder account, like this. Transfer equity share capital to equity share capital account, equity shareholder account. So you transfer this also, you transfer this also. Transfer reserve and surplus to equity shareholder account. If reserve and surplus are negative, then here. If fictitious assets are there, then there. Okay. So see, you have targeted the balance sheet and totally all the balance sheet items are transferred at their respective places. Now the balance sheet is empty. So once again, transfer all assets, all liabilities to relation account. Next, equity capital, reserves, losses, everything, dividend, fictitious assets, transfer to equity shareholder account. Preferential capital, transfer to preferential shareholder account. Cash bank, if taken over, transfer to relation, not taken over, make it separately. Guys, till now, 4 points are there. Have you understood this or not? Everyone, please tell me, have you understood this concept or not? All right. So all 4 items transferred. All 4 items transferred. Now the next step. So sir, what was the step? Sir, what was the step? Step 1. Empty the balance sheet of RR. This was step. Transfer all the asset liabilities in their respective places. Now step 2. Raise the PC and receive the PC. Raise the PC, receive the PC. Sir, what is raise the PC and receive the PC? Raise the PC means transferee company account debit to realization account. It is called raise the PC. It is called raise the PC. And receive the PC, cash, preference shares, equity shares to transferee company account. It is called receive the PC. Raise the PC, receive the PC. Raise the PC, receive the PC. Raise it, receive it. When you will raise it, the realization account will be there by transferee PC. This is step number 2. Raise the PC. Receive the PC. Tell me guys, this is step number 2, understood or not? Tell me guys, step number 2 understood or not? Raise the PC, receive the PC. Step number 3. Distribute PC to preference shareholder first. Only preference holder, not equity holder. You receive the PC now. Now distribute the PC to preference holder. When you will distribute the PC to preference holder, here you will give them these preference shares, new preference shares. You will distribute the PC. Distribution of PC. This is your third step. Distribute PC to preference holders. Guys, understood or not? Suppose it was at 1 lakh. And suppose the new PC was 110. This could arise. Or vice versa. This is 1 lakh and the new PC was 90,000. Understood this? Now close this account through realization. So distribute the PC to preference holders first. Preference holders first. And close preference shareholder account through realization account. Distribute the PC to them, preference holders account, and close preference holder account to realization account. To close this account by realization or to realization. Either this or this. Guys, have you understood or not? And you will charge here to preference shareholder account. So what are the steps? Step 1, empty the balance sheet of transferor. All the items in their respective places. Assets, realization, liabilities, realization, equity capital, reserve and surplus, equity shareholder fund, equity shareholders, preferential capital transfer to preference holder, cash and bank prepare separately if not taken over, or transfer to realization account if taken over. Second, raise the PC, receive the PC. Third, distribute the PC to preference holder and then preference holder to be closed. Now, maybe apart from cash, some other assets or liabilities may not be taken over, but you transferred all assets liabilities to realization account. Maybe the plant and machinery not taken over. Maybe the liabilities not taken over. It could happen. So the fourth step is those assets liabilities which are not taken over are sold, settled, through realization account. Asset not taken over to be sold. Liability not taken over to be settled through realization account. So in the realization account, by cash to cash. Liability settled. Liability not taken over. Settled. Asset not taken over. Sold. Tell me guys. Step number 1, empty the balance sheet. Raise the PC, receive the PC. Distribute the PC only to preference holders. Those assets and transfer the preference holder account through realization account. Those asset liabilities which are not taken over to be sold, settled separately through realization account. Even the to cash, by cash is there. So even there is by realization, to realization is there. Okay. Last. Now, actually not last, but now done. Step number 5. Close realization account. Now you can close the realization account. Now close the realization account. And whatever the gain loss, transfer to equity shareholder account. Whatever the gain loss, transfer to equity shareholder account. So to equity shareholder gain by equity shareholder loss. Guys, understood? So close the realization account. Okay. Here also, to realization, loss, by realization, gain. Again, you entirely empty the balance sheets, all the assets, liabilities at their respective places, raise the PC, receive the PC, distribute the PC only to preferential holders first, and then close the preferential holders account through realization account. Assets, liabilities which are not taken over to be sold and settled separately through realization account. Last, realization account to be closed, gain and loss transfer to equity holders account. Step 6. Final balance of equity shareholder account should be equal to PC shares of equity shareholders and cash balance. Now at last, their final balance of this account should be equal to remaining PC, because you have received the PC now, but you have distributed the PC to preferential holder earlier. So remaining PC of equity shareholders as well as cash balance of this cash account should be equal to the remaining balance of equity shareholders. So equity shareholders remaining balance should be equal to the PC value and cash value, and close it. Distribute them to cash to equity shares. That's it. To cash to equity shares. Distribute PC and cash to equity shareholders. These are the steps, six steps where you can do your full-fledged transferor company question. Any doubt in this? Any doubt in this, guys? So in this way, we have completed all the basic concepts. All the basic concepts. Basic means not basic. All the entire concepts of amalgamation. Guys, now for the next 1 hour only, I'll take not more than 1 hour. In the next 1 hour only, I'll discuss with you few questions, 2 important questions, which will cover the accounting for transferee as well as transferor. Okay, so whatever we have understood till now, we will discuss all the things through some questions. Okay, and after the completion of entire session, this entire file, this entire class notes file, I will share with you, everyone. Okay, so let's start. So I want you to just open this page. If you have these notes, you must have these notes. The page number is 172. These are the master questions, and this is the first question we'll discuss. Question number 138. Okay, in this question we'll cover accounting for transferee company purchase method, and we'll try to cover up the pooling of interest method, that is the merger, in the nature of merger also in the same question. So in this question we'll cover accounting in the nature of merger, accounting in the nature of purchase, both the things in one question. Then after that we'll take one more question for transferor company, overall 2 questions. Okay, so please come up with this question number 138. Question number 138. All right, guys. And if you have any doubts, you can accumulate these doubts, and you can ask me your doubts after completion of these 2 questions. All right. So let's start. Question number 138. Accounting for transferee books purchase method. Balance sheet as on 31st March 24. Now, there's a equity share capital. There's a 9% preferential capital, 8% preferential capital of transferor. General reserve, profit and loss, export profit reserve. Guys, it is a statutory reserve. It is a statutory reserve. What we discussed earlier in respect of statutory reserves, that in the nature of purchase, such statutory reserves need to be recorded by transferee company by passing a special entry. Amalgamation adjustment reserve account debit to statutory reserve. 7% debentures, 6% debentures, creditors, PP, investment, inventory, trade receivable, cash and bank balance. Now, 8% preference holders shall be given new 9% preference shares at 20% increase in value. At 20% increase in value, shares to be issued at par. Please tell me, guys, is this a PC or not? PC is anything which is payable to the shareholders. So tell me, is this a PC or not? Is this a PC or not? Of course, it is a PC because 8% preference shareholders will be given new PC. It's a PC. It's a PC. Yes. So how much we are giving them? We'll give them new preference shares at 20% increase in value. 20% increase in value. Okay. Next. So in rough, what is the value? The value would be 6 lakh plus 20%. Can you please do this? 6 lakh plus 20%. It's 7 lakh 20,000. It's 7 lakh 20,000 PC for preference shareholders. PC for preference shareholders 7 lakh 20,000. Guys, understood? Yes or no? Next. Purchase consideration to equity shareholder shall be discharged under. It is also PC because they are talking about equity shareholders. We'll give them cash of 3 lakh and equity shares of transferee 5:4. Oh, exchange ratio. It's an exchange ratio 5:4. And the market value per share of transferee is 28 rupees. So we'll calculate the PC like this. Wait. The question number is 138. The question number is 138. Okay. There is bit camera issue. Wait a minute. Just wait a minute. Question number 138. For the first working note you will do is calculation of PC. Calculation of PC. First working note will be calculation of PC. Payment in working amount. Payment to preference shareholders of transferor. Payment in, we are giving them 9% preference share capital of transferee. Working 20% increase in the value. That means 6 lakhs plus 20%. That means 7 lakh 20,000, which we will issue them at par. So what is the par value? 10 rupees. So 720 divided by 10. So how many number of shares we'll issue? 72,000 number of shares. 72,000 number of shares we'll issue. Then payment to equity shareholders of transferor. Payment in cash. It is given that we'll give them cash of rupees 3 lakh. We'll give them cash of rupees 3 lakh. Again, payment to equity shareholders of transferor. Payment in equity shares of transferee. The exchange ratio is 5:4. So, on what numbers? The number of equity shares are 8 lakh divided by 10. Transferor 8 lakh share capital divided by 10. How many shares are there? 80,000. So to the shareholders holding 80,000 shares, we'll give them new shares in the ratio of 5:4. For every 4, we'll give them shares, 5 shares. So 80 divided by 4 into 5. So we'll give them 1 lakh number of shares. 1 lakh number of shares, and such share will have a value of 28 rupees. 28 rupees. Such share will have a value of 28. So it's 28 lakhs. It's 28 lakhs. It's 28 lakhs. So overall, the PC is this. Can you please make a total? Can you please make a total? Overall, the PC is this. Are you guys available now? Because I'm not getting the proper replies from you. Everybody? Total, including 720. Including 720. It's 38 lakh 20,000. It's a total PC. 38 lakh 20,000. Okay. Guys, any doubt till this point? Tell me, guys. Any doubt till this point? It's a PC. The first one. All right. Now the next thing. 2 points are done. Now, even the market value is also complete. The market value of PPE and investments of transferor are 1150 and 620. Now, why they are giving market value of PP and investment? We already calculated PC, and we are not requiring the method 3 net asset method. Logically, the PC has already been calculated, method 1. So we don't need method 3 net asset method. So why they are giving the market values? Because in the purchase method, in the amalgamation in the nature of purchase, we record the assets and liabilities at market value. So this is for the recording purpose. This is for recording purpose. This is for recording purpose in the nature of amalgamation in the nature of purchase. As far as nature of purchase is concerned. One more thing. Suppose the exchange ratio is not given. The exchange ratio is not given. That means method 1 we cannot follow. Suppose method 2 also we cannot follow. Deemed exchange ratio. What to do? We have to calculate the PC by method 3. That means net asset method. And for calculating the net assets, PC calculation by net asset method, we need to consider the market values of PP and investment of 1150 and 620 because they are available. So it depends what information they are giving to us. Right now they have given exchange ratio. If they are not giving exchange ratio, we can use the net asset method. And under net asset method, we'll take PP and investment at these values. Guys, are you understanding or not? Yes or no? Tell me. All right. Okay. So, market value of PP investments. Trade receivable shall be subject to a provision of doubtful debt for 2%. So, trade receivable 2%. Trade receivable of transferor. All are they PP, investment, trade receivable, they are talking about the transferor company. Please do not look into the transferee because transferee company is taking over transferor. So, we'll talk about the asset liabilities of transferor only. So, trade receivable 6 lakhs. 6 lakhs multiplied by 2%, that is 12,000. Provision. 6% debenture holders will get new 7% debentures at an adequate amount so that interest amount would be same. Can you guys please calculate? Can you guys please calculate this when they are saying that 6% debenture holders, 6% debenture holders means this. They will get new 7% debentures in such a way that the interest amount would be same. Can you please calculate? Tell me, what should be the value? Tell me, what should be the value? Settlement value. $514,286. Ankit. Okay. Anybody else? Anybody else? Anybody else? No? See this. We'll do settlement value of debenture holders of transfer company. Right now, they are getting the interest of 6 lakh multiplied by 6%. They are getting this interest value. Now, the same interest amount they want from the new debentures. So, new 7% debentures value would be, they want same debenture value, same interest value with 7% debentures. So 36,000 divided by 7%. It should be 514,286 approx. 514,286. It's a settlement value of debentures. Settlement value of debentures. Guys, have you understood this concept? All right. Next. So this is also done. EPR to be maintained for 2 years more, 2 more years. All right. 2 more years. All right. So we'll maintain the EPR by passing another entry, amalgamation adjustment reserve. Amalgamation adjustment reserve. Debit to EPR. EPR means export profit reserve. This is the EPR. Export profit reserve. Next, there is an unrecorded liability of RER towards creditors for goods of 30,000, which is also assumed by RE. Not an issue. We'll take over this liability also. Now calculate. Actually it is calculate PC. We calculated the PC. Calculate PC. It's already done. Pass journal entry in the books of RE. All right. Let's pass journal entry now. Journal entry. Now let's pass journal entry. Wait a minute, guys. Wait a minute. All right. So journal entry in the books of transfer RE. So first journal entry will be business purchase to liquidator of transferor. Business purchase to liquidator of transferor. The amount should be the PC value. It should always be at PC value. 38 lakhs 20,000. Journal entries we already discussed earlier. We already discussed earlier the journal entries like this. These are the journal entries we'll do it. Okay. The second entry is assets and liabilities entry. Acha, this is a purchase method. This is a purchase method. So second entry is the asset and liabilities. So every asset and liability to be recorded. Okay. So market value of PPE and investments are taken 1150 and 620. So PPE account debit 1150 and investments 620. So as far as PP and investments are concerned, we took the market value because it was given. Suppose it was not given, then we'll take the same value. Okay. Next, inventory. Are they talking anything about inventory? No, they are not talking about inventory. So inventory will take at the same book value. Inventory will take at the same book value. Inventory will take at the same book value. All right. Guys, one correction is required. I think there is a total issue in this question. Just let me calculate. 9 plus 7, 6 and 2. Yes, there is a total issue. I think inventory should not be 7. I think inventory should be 6 lakhs. I have to check the solution whether it is done or not. Yes, inventory is 6 lakh. So there is one correction, guys. Please, this is a 6 lakh. Actually, the total is not matching. It should be 30 lakh. So inventory should be 6 lakhs. So inventory, it should be 6 lakhs. So inventory should be 6 lakhs. Then the trade receivable. Trade receivable is 6 lakh subject to the provision for doubtful debt of 12,000. So what we'll do? We'll record trade receivables at gross value of 6 lakh and separately we'll record provision for doubtful debts 12,000, because they are asking us to create a provision for doubtful debt. They are not telling us to reduce the debtors. It depends what language they are using. They are using subject to the provision of doubtful debt. Suppose they say trade receivables are to be taken at 2% reduced value. Then instead of doing this, I will deduct 12,000 directly from trade receivables, because they say 2% reduced value. But right now they are not saying 2% reduced value. They are saying subject to the provision. That means they want us to show the separate provision. Okay. So trade receivables are there. Then cash at bank. Cash and bank debit. Cash and bank debit 2 lakhs. All assets are done. Now it's time for liabilities. First of all, creditors. Two creditors. Creditors are there. Creditors are of 4 lakh. But other than that, there was an unrecorded liability of transfer towards creditor for 30,000. So we'll record the creditors of 4 lakh 30, including unrecorded liability. Including unrecorded liability. Okay. Next, other than creditors, now there's a debentures. As far as debentures are concerned, we'll do debenture holders of transferor. At which value? At settlement value. We calculated the settlement value. It is always the settlement value 514286. 514286 at settlement value. Then creditors done, debentures done, debentures of not required. Export profit reserve. See, as far as reserves are concerned, under purchase method, we don't take any reserve other than statutory reserve, and that too we take the statutory reserve by passing separate entry. So reserves here are not required. So to business purchase, 38 lakhs 20,000. Now please tally this entry. If you will get any difference, that will be either goodwill or capital reserve. Please tally this entry. Please tally this entry. Guys, anything? What figure you arrived? It's 1606286. Yes. Mine also 1606286. Balancing figure 1606286. 1606286. It's balancing figure. It's a goodwill. So goodwill is 1606286. So this was the second entry. Now third entry, we need to pay the PC to liquidator. So liquidator account debit 38 lakh 20,000. 2, we need to pay to liquidator. What we need to pay? 9% preferential capital, cash and equity share capital. So 9% preferential capital issued at par, then cash 3 lakhs, then equity share capital. So as far as equity share capital, the total value is 28 lakh, but the number of shares are 1 lakh, issued at 28. What is the face value? The face value is 10 rupees. So equity share capital 10 lakhs. 2, security premium 18 lakhs. Security premium 18 lakhs. So equity share capital, that is 1 lakh multiplied by 10. The rest is the premium. Security premium 1 lakh numbers multiplied by 18. It's a security premium. So liquidator also paid. Now fourth entry, debenture holders. The debenture holders are to be settled with the new debentures. So debenture holders debit 514286 to new debentures. New debentures as per our working note was 7%. To 7% debentures 514286. 514286. Then any other entry? Yes, export profit reserve, statutory reserves. So fifth entry, amalgamation adjustment reserve debit to export profit reserve of transferor. That means 50,000. 50,000. Any other entry? No. Everything is done. PC's entry is done. All assets liabilities are done. Debenture holder settlement is done. EPR is done. Unrecorded liabilities also taken over. Everything is done. All entries are done. All 5 entries are done. All right, guys, tell me, understood? So all entries are done. Now the last requirement, prepare the balance sheet. Prepare the balance sheet of transferee. So how we'll prepare the balance sheet? See this. The balance sheet of transferee after amalgamation. The balance sheet of transferee after amalgamation. All right. First of all, equity and liabilities. The first one is share capital. Now, what is the share capital of transferee? 12 lakh equity. Equity share capital. The equity share capital of transferee is 12 lakhs. 12 lakh plus as per the entry. What was the equity share capital? 10 lakh. This one. So 12 lakh plus 10 lakh. That means 22 lakhs. The next is 9% preferential capital of transferee. 9% preferential capital of transferee. It was 8 lakhs. Plus here the 9% preferential capital was 720. So it means 1520. Okay, two things are done. Third, preferential capital of RER not required now because PC we have given in the form of our preferential shareholders. General reserve 5 lakh. The general reserve transfer RER not required because we haven't taken over. See the entry. In any entry, we haven't taken over any general reserve. In the nature of purchase, we don't take over the general reserve and P&L. So second is reserves and surplus. General reserve directly 5 lakhs. Next is P&L, also same 350 only because the general reserve and P&L of RER are not required to be maintained. So 350 P&L. 350 P&L. Then export profit reserve. Yes, we have taken over export profit reserve of 50,000. Export profit reserve of 50,000. And also amalgamation adjustment reserve as a negative figure 50,000. See the entry. Amalgamation adjustment reserve to export profit reserve. So this is done, this is done. And amalgamation to be shown as negative figure. Other than that, security premium was also there. See this entry. Security premium 18 lakhs. So all these are reserves and surplus. All these are reserve and surplus. Now the third item, the debentures. Third item, debentures. So long-term borrowings, debentures, 7% debentures. So whatever the 7% debentures of transferee, they were 750. And the new 7% debentures we issued, this one, 514286. 514286. This one we took. Okay, so 514286 plus 750, it's 1264,286. Then the creditors. The creditors of transferee are 4 lakh and the creditors we acquired are 430. So overall creditors are 4 lakh plus 430, that is 830. So you can do the total after assets. Now PPE. What was the PPE of transferee? It was 13 lakhs. And what PPE we acquired? It's 1150. So 13 plus 1150, it's 24,50,000. Then, sorry, goodwill. After PP, there's an intangible asset. Now, so goodwill directly we calculated 16,06,286. 16,06,286. Okay. Then investments. What was the investment value? 9 lakh. Transferee. And at what value investment we took? 620. So 1520. Fourth one, investment done. Now inventory. What was the inventory value? Inventory value was 10 lakh and 6 lakhs. 16 lakhs. It's 10 plus 6. We acquired the inventory at 6 lakhs. Now the next one is trade receivable. It is 5 lakhs. It was 5 lakh. We took over at 6 lakhs. We took over at 6 lakh and we created the provision for doubtful debt. This is to be shown as a reduction from trade receivable. Here, minus 12,000. Provision. Provision you cannot show on the liability side. Mind it. Provision you cannot show on the liability side. $1088. Then cash and bank balance. What was the cash and bank balance? It was transferees cash and bank balance was 3 lakh and we took over 2 lakh. Goodwill already taken over. We took over the cash of 2 lakh. And other than that, we paid the cash of 3 lakh. We paid the cash of 3 lakh. So 2 lakh and we paid the cash of 3 lakh. So it is net 2 lakh only. So once again, transferees cash was 3 lakh. We took over 2 lakh and we paid 3 lakh in the form of PC. Okay. So everything is done because business purchase, debit, business purchase, credit, cut down. Liquidator credit, liquidator debit, cut down. Debenture holder credit, debenture holder debit, cut down. Rest everything is ticked. So all is done. You can tally your balance sheet now. 2450, 1606, 286, 1520. What is the balance sheet total? Can you guys help me? I think it's 84 lakhs, 64,286. Liability side. Yes. 84, 64, 286. This was amalgamation in the nature of purchase. If you have any doubt, you can ask me. Tell me, guys. Any doubt you have? All right. So now same question as per merger. That means pooling of interest method. What will be the changes? If you do same question as per merger, what will be the changes? First, PC would be same. PC would be same. That means 38 lakh 20,000. PC working would be same. Entirely same. 38 lakh 20,000. Why, sir? Because I already told you that as far as PC is concerned, it doesn't matter you are doing amalgamation in the nature of purchase or in the nature of merger. Second, settlement of debentures. Same. That means 514286. Same. Settlement of debenture same. Yes, there might be some differences in journal entries. Because now in the merger pooling of interest method, we record all assets liabilities at book value, as well as we need to maintain all the reserves and surplus of transferor company. So yes, journal entries would be different. Journal entries would be different. So what is the first journal entry? The first journal entry is business purchase account debit. You can do anything, business purchase, business merger, doesn't matter. To liquidator. The first entry is also same. 3820, 3820. There's a difference in second entry. Now, the PPE investment inventory trade receivables all will be recorded at book values. So what are the book values of PP? 976, it's 9 lakh, it's 7 lakh, it's 6 lakhs, trade receivable also 6 lakhs, cash 2 lakhs. All the same book values, simply. Okay. Some gap is required. Two. Provision for doubtful debt. Sir, do we need to create provision here also? Yes, in the merger also we can create provision if they require. So provision for doubtful debt 12,000. To debenture holders, yes, it is always at settlement value. It is always at settlement value, whether it is merger or purchase. Always settlement value. Two creditors 430. That means the book value of creditors as well as the unrecorded liability. Sir, in the merger there is the unrecorded liability. We need to consider a bit of unrecorded liability is not a subject matter of accounting. Unrecorded liability is a subject matter of negotiation part. Like when I have made a negotiation with the transferor, I agreed that okay, I will take your recorded liability as well as some of the unrecorded liabilities. So unrecorded liabilities also considered under the merger also. Okay. So provision, debenture holders, creditors. Two. Then business purchase 38,20,000. And not only assets liabilities at book value, we'll consider export profit reserve also. We'll consider export profit reserve also. All right. We'll consider export profit reserve also. Other than that, what we'll consider? All other reserves also. All other reserves also, like general reserve and P&L. Take general reserve first. To general reserve. General reserve 3 lakh. And then take P&L. What you can do? P&L, instead of writing this P&L 250, you can take the P&L as a balancing figure, because in this entry whatever the difference is, we have to consider it as a balancing figure. So can you please calculate the balancing figure? 9 lakh 7 6 6 2 minus 12 514286 430 3820. Can you please calculate the difference? The difference is on the debit side. Guys, difference is on the debit side. Can you please calculate the difference? I got the difference now. I got the difference now. The difference is on the debit side. That is P&L account debit. How much? 207,6286. The difference is 207,6286. So no need to write the P&L on the credit side. See, it is like either you write the P&L 250 on the credit side, the difference will be more. Again, the difference will be more by 250. So logically, the P&L will be net. Even now, you can net the general reserve part with the P&L part. Even the general, even if you want, you can net. Don't write general reserve and write the P&L net part also. You can do this also. Tell me, guys, have you understood this concept? Have you understood this concept? All right. So what you can do, either you can write like this, or instead the general reserve also is not required because the P&L is getting debited. It means it is a minus. It's a negative figure. So instead of writing general reserve, you cannot disturb the EPR and other reserve. You can just disturb two reserves, general reserve and P&L only. You can make the adjustments. Okay. So here we return general reserve as 3 lakhs. And after that, our balance of P&L was 2076. Instead of doing this, what we can do not write general reserve here. And the P&L would be 2076. What was the P&L? 2076, 286 minus 3 lakhs. The P&L would be 1776, 286. The P&L would be this one. This is a balancing figure. Rest all entries same. Rest all entries same. But no need to do this entry. Amalgamation adjustment reserve to EPR. No need to do this entry. Because EPR we have already considered in the second entry. Okay, simple. So rest all entries are same. In the balance sheet, what will you do? Same balance sheet you will prepare same way. Now you take the PP 9 lakh, you take the investment 7 lakh, you take the inventory 6 lakh, and when you will write the reserves, now the P&L of transferee 350 and the negative balance of P&L of 1776, net P&L will be the negative balance, like that. So this is called merger. Tell me, have you any doubt? You can prepare the balance sheet and your balance sheet will definitely be tallied with the help of all these entries. So this was amalgamation in the nature of merger as well. So we completed the transferees books of transferee, amalgamation in the nature of merger, in the nature of purchase. If you have any doubt to ask, you can please ask it. One more thing. This is also a very good question. However, all the questions given in this master question list, all are need to be considered by you guys. But for me, it is not possible to cover each and every question in this marathon. Okay. So there are some limitations, but what you can do, you can cover all other questions. In some of the question, you will get QR. So QR code. By scanning this QR code with your mobile, with any scanner you have, you will get the video solution of this question. So some questions have scanner also, QR code also. Some questions have. So you can solve all these questions. All these are must do questions considering the exams. Okay, considering the upcoming exam, these are all the must do questions, master problems. So you can try all these questions. Some of the questions contains QR, so that you will get the confidence by by watching the video sessions also. So now I'll discuss one last question in the books of Transferor, accounting in the books of Transferor. One last question, that is question number 144. Question number 144. But before discussing last question, I want everyone that everyone should reply whether you are understanding the things or not. Whether you are understanding the things or not. Tell me, because you guys are not actually replying on time. Tell me what happened. If you have any doubt, you can ask me. Tell me, if you have any doubt, you can ask me. No? All right. All right. So there is one more question, question number 144. However, this question also contains QR, but I will discuss it. I will discuss it with you. So there is a company Mohan Limited which gives you the following information: equity 9% cumulative preference shares, profit and loss, debit balance they have, debentures, interest payable on debentures, trade payables. These are the equity and liability side. Now property, plant and equipment, goodwill, inventory, trade receivable, bank balance. New company Ravi Limited is formed with an authorized capital of 4 lakh divided into 40,000 equity shares of 10 each. The new company will acquire the assets and liabilities of Mohan on the following terms. Mohan Limited debenture are paid by similar debentures in the new company, and for the outstanding Mohan debentures are paid by similar debentures in the new company. New company will pay the similar debentures. Okay. Outstanding accrued interest on debentures, equity shares of equal amount are issued at par. Okay. For debentures, the same new debentures will be given. For interest payable on debentures, they will give us equity share. But both are not PC. Both are not PC. The trade payables are paid by issue of 12,000 equity shares at par in full and final settlement of their claim. Even the creditors' trade payables are to be given equity shares. This is also settlement, but they are not the PC. So the settlement value of trade payables are 12,000 multiplied by 10 rupees. That means the settlement value is 120. So 150 trade payables are to be settled at 120. the preference holders are to get equal number of equity shares issued at par. So preference shares, they will get equal number of equity shares. So preference shares 60,000 divided by 10. So if we calculate the PC calculation. So preference shareholders, they will get equal number of equity shares at par. So 60,000 multiplied by 10. 6,000 multiplied by 10. That means 60,000. Dividend on preference shares is in arrear for 3 years. From last 3 years, we haven't paid the dividend to the preference shareholders of Mohan Limited. But preference shareholders to forego dividend for 2 years. For the balance dividend, equity shares of equal amount are issued at par. Out of 3 years dividend, the 2 years dividend will forego, waived, and for 1 year dividend, we'll pay them. The new company will pay them. So it is also PC. So can you please calculate the dividend? 1 year dividend, 60,000 multiplied by 9%. The 1 year dividend is 5,400. The 1 year dividend is 5,400. So 5,400. 1 year dividend, 5,400 rupees. So 540 number of shares. So it's 5,400. So total PC for preference shareholders is 65,400. Okay. I think there is one doubt of student in merger. Why capital reserve and goodwill is not coming? See guys, 2 things are. I will definitely give you the logic. That why goodwill and capital reserve is not coming. But before providing you the logic, I would say one thing, that your exams are near. After 15-20 days, your exams are there. At this point of time, you should understand. See, it's very good thing that we should understand the concepts. But when there are only 15-20 days are there now, sometimes we need to understand that. Leave the concept. At least learn the concept. Leave the concept understanding. If we don't have the time, at least learn the concept, because exams require us to write everything. Okay. I'm not telling you that goodwill and capital reserve is coming in the purchase only and in the merger, not in merger, because it's a rule. I will definitely tell you the concept. But if you think that you are doing the self-study and all, and while doing self-study, you are getting so much doubts, these kind of doubts, conceptual doubts, please, it's a request to everyone. You have to understand that now it is no time for you to understand the concept. You have already wasted your so much of past 8 months. Why you haven't understood the concept in the past 8 months? Coming to the concept. In merger, why we don't write capital reserve and goodwill? Earlier only in the session, while understanding the concept, I already told you that amalgamation in the nature of merger means common control, common decision making. And in the nature of purchase, it's a dominance. So whenever you purchase a company, by dominating that company, you negotiate with them and you try to pay them a lesser PC. When you try to pay them a lesser PC, you get a gain, and such gain is transferred in capital reserve. Transferor will try to get the higher PC, and if you are paying them higher PC, you will treat it as a goodwill in the nature of purchase. But as far as merger is concerned, there is no dominance. There is no single control with the transferring. In merger, I already told previously that in merger, we try to maintain the same images of balance sheets of both the companies. Here, in conceptual sense, transferee is not taking over. Transferee is requesting to transferor, please merge with me, so that we can do work together. We can control the business together. We can do decision making together. So there is no sense of goodwill or capital reserve, because capital reserve means the gain to the transferee. In merger, there is no question of gain or loss to anyone. They both are equal. So what they decided, that there is no question of goodwill or capital reserve. While doing merger, whatever the differences will be there, it will be our profit, our common profit, general reserve and P&L, and this is the reason we transfer it in the general reserve or P&L. So this was the concept I given. Okay, fine. But everybody has to understand that whenever we have only 15-20 days remaining, we should not waste our time in concept understanding. If we think that concept understanding will take so much of our time, our precious time. Leave that concept understanding. Just learn that. And this is a highly recommended guidance for everyone, because what students do that they try in the last 15-20 days, they try to think from conceptual point of view. Guys, why you are doing this time only? Why you haven't thought, why you haven't think about this previously? What were you doing in the last 8 months? So do not waste your time right now, at least in the conceptual part, if it is taking the time. Okay. Next, the equity shareholders are issued 1 share at par for every 3 shares held in the Mohan Limited. Simple exchange ratio. So equity shares are 3 lakh divided by 10. So equity shareholders PC is 30,000, multiply by what is the exchange ratio? 1 share at par for every 3 shares. Issued at par. That means 10 rupees. 1 lakh. Next. Okay. So the total PC becomes 165,400. This is the total PC to shareholders of Mohan Limited. Next, current assets are to be taken over at book value except inventory, which is to be reduced by 10%. Goodwill is to be eliminated. Goodwill they are not taking over. Property, plant and equipment is to be taken over at 308. See, they are giving you the values. These values are to be considered by new company Ravi Limited. Mohan Limited will close its books every time at book value. Remaining equity shares of the new company to be issued to the public at fully paid, not required in the books of Mohan Limited. Expense of 5,000 to be made from the bank balance of Mohan Limited. This is to be adjusted from the bank balance of Mohan Limited before acquisition of Ravi. So Mohan Limited has a bank balance of 20,000. Out of 20,000, Mohan Limited will incur 5,000 of expense, and then the remaining 15,000 will be taken over by Ravi. So Mohan Limited will incur 5,000 of expense. Okay, you are required to prepare the relation account and equity shareholders account in the books of Mohan Limited. So what I will do, I will prepare the books of Mohan Limited. That means the transferor company. So earlier I told you these steps for transferor. Empty the balance sheet of transferor at book value. Raise the PC, receive the PC. Distribute the PC to preferential holders first and close the preferential holder account through relation. Then those assets and liabilities which are not taken over or not sold, taken over are to be sold or settled through relation account. Close the relation. Transfer the gain loss to equity holders. The remaining balance of equity holders will be equal to the PC and cash. These are the 6 steps. The same steps I will do for you. First is we prepare the relation account. All the accounts we'll prepare simultaneously. We'll prepare the cash account. We'll prepare preferential holder account. We'll prepare equity shareholder account. And we'll prepare Ravi Limited account, that is transferee account. However, they are just asking us 2 accounts, relation and equity shareholders. But I am preparing all the accounts for the important understanding of the entire things. Now, first step to close the books, to empty the balance sheet at book values. So what is the book values of each and everything? Property, plant and equipment, 340. Goodwill, everything need to be closed at book value. Please don't look at the market values. Market values will be taken by new company, recorded by the new company. We are not concerned with the market values. To inventory, 80,000. To trade receivable, 110. Now, as far as bank balance is concerned, not the entire 20,000 is getting taken over, out of the which 5,000 are being the expense made by the Mohan Limited. So what we will do, we'll first, it's not a cash, it's bank balance. We'll first write the opening balance of bank 20. So all the balance sheet asset side items we transferred at the respective places. Now, as far as liability items are concerned, first equity capital transfer to equity shareholder account. 3 lakh. Second, preference capital, try transfer to preferential holder account. Then profit and loss debit, transfer to equity shareholders account. It's a debit balance, hence on the debit side, because it's a debit balance. Negative. Debentures, transfer to the realization account. All assets liabilities to be transferred to the realization account. Debentures, 10% debentures, 2 lakh. Interest also, it's a liability, transfer to realization account. All assets liabilities transfer to realization account. Interest payable. Trade payables also 150. Sir, settlement value is 120. We empty the balance sheet at book values, guys. We need to close the books. Settlement value is a concern of new company. New company will record the liabilities at settlement values. Okay, so what we did, we empty the balance sheet. Each and every item of balance sheet we transferred at their respective places. Now, the first thing is done. The first step is done. The first step is done. But yes, there is one more issue. They are saying that 5,000 expense to be made by Mohan, and then the remaining 15,000 of cash will be taken over by Ravi. So yes, we have to do this also. So expense from a bank account, they are doing expense by realization account. Expense of 5,000. So here to bank of 5,000. The rest 15,000 will be taken over. So the remaining cash which was taken over should be transferred to the realization account by realization. Closing to realization. Done. Cash account, bank account done. So to bank. We closed the bank account also. So overall, our first step is done. Empty the balance sheet of transfer at book value. Now the second step, raise the PC, receive the PC. Raise the PC, receive the PC. So PC is what? PC is 165,400. Raise the PC. We will get the PC from Ravi Limited. So Ravi Limited account debit to realization account. 165,400. Ravi Limited account debit to realization account. Raise the PC. So Ravi Limited account debit to realization account. That means by Ravi. 165,400. Now receive the PC. PC to be received. What PC to be received? By equity shares in Ravi. We receive the PC. These are the equity shares. These are the equity shares. Overall, we receive the equity shares 165,400. 165,400. Raise the PC, receive the PC. Second step done. Raise the PC, receive the PC. It is raised. It is received. Raise the PC, receive the PC. Now, third step. Distribute the PC first to the preference holders. Distribute the PC first to the preference holders. So as far as preference holders are concerned, their PC is 65,400. So distribute them. So to equity shares of Ravi Limited, 65,400. See, read this. Preference shareholders are to get equal number of equity shares. They are getting also equity shares, not the preference shares. So distribute the PC. Now any difference is transferred to realization account. So transfer to realization. 5,400. This is on the credit. So here it is on the debit. To preference shareholder 5,400. So third step is also done. Third step is also done. Distribute the PC to the preference holders first. Close preference holder account through realization account. Now fourth step, assets liabilities which are not taken over. In this question, all the assets liabilities are taken over. Everything is taken over because they are paying creditors also, they are paying to the debenture holders also, they are paying to the interest also. All liabilities are taken over. So step number 4 is 0. Step number 4 is 0. Now step number 5, close the realization account and transfer the gain or loss to equity holders. Yes, now close the equity holders account. Realization account, sorry. Preference holder account is closed. Close this. 30,000 loss, if I'm not wrong, by equity shareholders account. You will transfer the loss of 30,000. 30,000. I hope you people are also calculating the figures. 30,000. 30,000. So 30,000 is a loss. We transfer it to the equity shareholders account. 30,000. This step is also done. Step number 5 done. Now I told you last step, the balance, the final balance of equity shareholders account will be equal to the PC and the cash. See the final balance. The final balance of equity shareholders account. 3 lakh minus 2 lakh. The final balance is 1 lakh, which should be equal to the PC. What was the PC for equity shareholders? PC for equity shareholders was 1 lakh. And the cash balance you don't have. 0. So the remaining balance of equity shareholders account is equal to their PC. So distribute them to equity shares in Ravi Limited 1 lakh. Distribution. We distributed the PC. That's all, guys. This was the books of Transferor company. If you want to solve the same question for the books of Transferee company, you can check this QR code. You can scan it. And the books of Ravi Limited also I have already discussed in the video session of this question, and the video session you will get through the QR. So guys, this was the books of Transferor company. Tell me, guys. Now tell me any doubt if you have. Otherwise, I'm done with everything. I'm done with everything. Points like goodwill calculation and all, you can see these questions. When you will see these questions, QR codes and all, you will get everything. In some of the questions, there are some goodwill treatments and also goodwill calculation part also. QR code is there. You can check the QR code video sessions. You will get the treatments of goodwill and all. So guys, this was the entire amalgamation from my side. I hope you got this point entirely. And if you guys are leaving, so before leaving, please tell me how was the session. Have you liked the session or not? I can understand that now this is exam days, and in the exam days you don't have the sufficient time, but also you can give me your feedback also for the, as far as the session is concerned. The entire amalgamation we tried to complete in almost 4 hours or 4.5 hours. So I have tried my level best, and in such 4 and 4.5 hours we completed each and everything, each and every conceptual part for amalgamation. I'm giving you this master problem questions for each and every chapter. This is a master problem question for each and every chapter. You can refer this at least for the exam purpose. Last day revisions, you can do all these questions. Okay. So guys, I'll definitely wait for your feedback. If you can give me your feedback, this is my number. This is my WhatsApp number. You can give me your feedback also on my WhatsApp number. Okay. Thank you, sir. I think now I can solve amalgamation easily. Thank you, Ankit. Thank you. Amazing session, sir. Thank you so much. Thank you, Anandan. Thank you so much. Amal, thank you. Mikdad, thank you. Ishani, thank you so much. Everyone, every student, and especially a special thanks to Trishur branch of ICAI. Thank you so much, guys, and thank you so much for inviting for this particular session. And in future also, I am definitely available for all of you guys. In future also, if you call me for this kind of session, I will definitely be available for CA intermediate advanced accounts as well as for CA final financial reporting also. So thanks a lot, Trishur branch, for calling me for these kind of sessions. Thanks a lot, guys. All right, so it's time for leave. It's time to leave, and before leaving, all the very best to guys for your exams. And if you want to ask any particular doubt, you can message me on this number. You can give me your feedback on this number also. Thanks a lot, guys. All the very best. Bye bye. Take care.